key point for growth really is how these tech stocks are doing.
The AI momentum in the near term looks pretty solid.
If there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market.
This is what we're calling a high risk bull market.
I'm very bullish. I think the market goes to new highs before Thanksgiving.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, just off record highs, the S&P 500 posting its biggest two-day rally since June as earnings from Zion's tempers fears about broader credit risk. Investors are now turning their attention to the embattled automakers. Earnings from GM. Up next.
Here's where it gets interesting. We heard from the banks, we heard from the airlines, a pretty clean read on the economy. The auto manufacturers are at the epicenter of a lot of the tariff concerns. They're at the epicenter of a lot of concerns about the consumer welfare and ability and willingness to spend, particularly on the middle class levels. How much do they give the same sort of sanguine look that we've seen? Do they give a sense of how much the costs of tariffs really are trickling out to the economy? These are the key questions a lot of people are looking for.
Those numbers drop in about 30 minutes' time. In many ways, that industry stuck between a rock and a hard place. The tariffs that Lisa talks about. And on the other side, EVs and attitudes to them.
Absolutely. There's wins and losses when it comes to this industry. They are higher tariffs, but the Trump administration recently gave a longer timeline for reduced tariff levels for imported parts. So they're getting some reprieve. On top of that, they're getting reprieve when it comes to emissions regulations. They're going to have to pay billions of dollars, or they were going to have to pay billions of dollars. They're not going to have to under this administration. But then, as you mentioned, the EV market, they're taking write-downs because there's an expansion of the EV market with the subsidies under the Biden administration. All of that has come to a pause under Trump.
The stock is a little bit softer this morning. You've got to make a decade-long investment decision, and you're being whipsawed by political cycles.
This is the difficulty right now. How do they give a forward look when they have to reverse on electric vehicles, when they have to come up with how much they can invest domestically, when they don't have a sense of what kind of reprieve they ultimately have? My ultimate question is, how much of a better situation are they in than the European auto manufacturers? Have they gotten the carve-outs they're looking for? How immunized are they to the threat coming from China? And how much have they fortified supply chains that really are going to be bulletproof no matter how the tariffs come through, even if the 232s are removed by the Supreme Court? These are the key questions.
The CFO, Paul Jacobson, joining us on the program from General Motors a little bit later this morning, 7:30 Eastern Time. Equities more broadly doing okay, just pulling back from close to all-time highs on the S&P 500, negative by not even 0.1%. Coming up this hour, we'll catch up with Drew Mattis of MetLife, with stocks coming off their biggest two-day gain since June. The former White House trade official, Kate Kalukowicz, as President Trump expects to deal with China, and Earl Davis of BMO on increasing odds of a 50 basis point cut at the Fed's December meeting. We begin this hour with stocks edging lower with a slew of earnings on deck. Drew Mattis of MetLife writing, in the absence of government data, the only information we have are earnings. Mediocre nominal growth expectations are out of sync with earnings expectations. Drew joins us now for more. Drew, good morning.
Good morning.
Does something have to give?
Something does have to give. Now, what that's going to be, I'm going to guess it's going to be markets, because it's easier for markets to give than it is for the economy to give. And if the economy gives, it's probably not giving in an unexpected acceleration in activity.
This is just one contradiction. There are many more. We talked about lots of them. Employment's dropped away. Retail sales has been really robust. People are still talking about the so-called K-shaped economy. Upper income okay, lower income struggling. Is one catching down to the other, or the other going to catch up to the top?
Well, just because someone's spending when they have money doesn't mean that they're doing fine, right? It doesn't mean that they feel like things are going to continue to be good. And when you look at the details of how income expectations are changing, particularly real income expectations, so accounting for the inflation component, what you see is actually that the upper income is beginning to feel a lot of pressure. I don't know whether it's what they're buying is just going up in price more aggressively, or whether they are beginning to worry about their jobs a little bit more. I suspect it's a combination of both.
Where are you seeing this in particular? And I say this as we were looking at airline earnings, for example, and a lot of people are shelling out for those premium cabins.
They shell out for the premium cabins, but those premium cabins cost more. And so they're actually seeing their lifestyle requires a much more expensive payment structure now. And so then they have to give in other areas. And so what we're actually seeing is when you look at spending, for example, goods versus services, people are beginning to actually cut back on spending on services. And those are the things that you never cut back on. And so typically, if you're not buying a cup of coffee in the morning, you're not going to go out and buy a car in the afternoon. It just takes a little while for that to catch up across the income spectrum. And what we're beginning to see now is that upper income tier is beginning to feel pressure. They can still keep spending, but the pressure builds, and it means probably that you'll see the savings rate begin to decline, even though it probably should be rising based on where interest rates are.
And maybe we'll get a holistic look at this when we get retail sales. Oh, wait, we don't have any data coming out of the government. There is this feeling right now. You need to parse through the earnings to get a better sense of it. Has there been anything in the earnings so far that has ratified the view you have, or are there a couple of earnings reports that you're really keyed into to give you the ultimate sense of whether this really is the reality, this weakening in even the upper echelons of income earners?
I mean, to be frank, no. But I mean, that's why I get to do what I do, is because I have to make decisions based on kind of the limited amount of information that I have. What we are paying very close attention to are Federal Reserve surveys. You have to pay attention to the Beige Book. You have to pay attention to the earnings reports. But even the earnings reports can see people transiting from one kind of product to another, right? From beef to chicken, or from, who knows what people like anymore. I don't understand actually what people, I am not the average consumer, and I am readily willing to admit it. And my tastes are not everyone's tastes. So it's hard to kind of figure out which direction everyone's heading. But I do know that people are shifting from what they're used to doing. And when people are shifting from what they're used to doing, that's happening because of a reason. And that reason typically isn't good. People are creatures of habit. They like to do what they did yesterday.
If the high-end consumer is under pressure, what kind of economy are you describing? Because everyone continuously says we're in a K-shaped economy, but what you're describing does not sound like a K-shaped economy.
So when you do economics for long enough, what you realize is the top 10% spends no matter what. The bottom 10% spends no matter what. And there's the cohort in the middle is actually the one that moves around their spending, because they've got some potential for savings. And so you really have to watch the movement into and out of the savings rate, and whether or not people are feeling like they can spend money. Now, it gets complicated when inflation's present, because oftentimes the way people make up for the increase in prices, at least initially, is by cutting back on their savings rate, even if they were feeling a lot of pressure or worries about their job. And so things begin to break down, those relationships begin to break down. And so, all the people using, AI to model the economy right now, it's the big new thing. Those models are incredibly complicated. And what you're going to see is that the coefficients on the front of each variable that you can use are probably shifting around, and they might be canceling each other out. And so your whole model might be breaking down, and you're probably not going to recognize it if you're using models that are too advanced, rather than looking at individual components of what's happening and the relationships between, for example, savings and interest rates.
What are you most looking at this week, next week, when it comes to earnings season, to really understand how much that high-end consumer is under pressure?
Well, as I said, it's difficult for us to kind of look at an individual company and figure out what's going on. Upper income consumers are going to continue to spend on things like airfare. They're going to continue to go on vacation. The question is, are they going on vacation, and instead of going to Europe, they're going to California? Or instead of going to, they're taking the slightly less expensive option. There are everyone's got a lifestyle, and certain things are downgrades for certain people. And it's easy for us to all kind of laugh about it, but for these people, it's actually a serious change in their lifestyle, and it affects their perception of what it means to be rich, for example. What's it mean to be rich when you actually have to think about the airfare? Right? These are people who are not used to thinking about how much they spend on airfare. They're not used to thinking about, I really like that hotel. It's in the center of the city, and it's my favorite hotel, because they have a favorite hotel in Europe, right? And now they're thinking, well, I can't afford my favorite hotel in Europe. I have to downgrade. It comes with a social cost. You don't have to cry for these people. Their lives are still really good, and probably better than a lot of people's. But, it doesn't mean that they feel as good as they used to.
Drew, banks aren't feeling as good as they used to after last week. Let's talk about the financials. Zion in the pre-market is up by 2.5%. It was the focal point of a lot of people last week, coming out and basically revealing some losses tied to potential fraud. This isn't the first time we've seen this kind of thing. We've seen some other credit issues as well. You've got the credit issues on the one side, and then really robust earnings on the other side. And we saw that from Zion overnight. How are you, and what is your perspective on what is happening right now in this sector?
Well, so people are nervous. If you look at credit markets, spreads are incredibly tight. So you're in this weird world where all-in yields are okay, right? The amount you can get paid for is okay, but the actual premium you're getting paid to take risk is actually maybe a little too low. And so I think what you're seeing is just the nervousness around the economy, that we don't really understand that everything's okay. We're waiting for that next shoe to drop. Jamie Dimon,
Sure.
put it famously. What he's really expressing is not that he sees anything, but that he's expecting something. It's kind of like you live in an apartment in New York City, and you might never see a roach, but they're there. You know they're in the walls. You know it, right? And so you don't leave food out. You do a whole bunch of different things when you live in New York. You know, there's things that you can do in suburban New Jersey, where I live, that are okay because you're not going to attract animals that quickly. But if you do it in New York City, you're basically stunk. And I think the risk is that people are really focused on what they're not seeing. And the fact of the matter is with no economic data and with, earnings kind of, being okay for the most part, they're nervous that they're missing something, but they don't know what they're missing.
So, Drew, where are we? Are we in a grad house on Murray Hill, infested with cockroaches? Or are we in a nice Soho apartment? What is this?
We might be trading down from a Soho apartment to something on the Upper East Side.
Okay. Does that mean you're de-risking?
We've been de-risked for a while now. I mean, to be honest with you, since COVID, there's been kind of one risk after another. And to the extent that we've been able to kind of go up in credit, we've been going up in credit. I don't think that's a surprise to anyone. And I think, everyone who's able to has been doing that. Or you've been looking to things like privates, where you're taking maybe more liquidity risk, which you can more easily define, but getting less credit risk on most sides of it if you're doing your underwriting properly.
Drew, good to see you. This was a trip.
Thanks.
Thank you, sir. Drew Mattis there of MetLife. Equity futures this morning doing okay, just pulling back from close to all-time highs on the S&P 500, negative by close to 0.1%, with an update on stories worldwide this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump signed an agreement with Australian Prime Minister Anthony Albanese to boost access to critical minerals and rare earths. The deal is part of efforts to secure stable supply of critical minerals, with Australia positioning itself as a viable alternative to China. Elsewhere, Sanai Takaichi won the parliamentary vote to become Japan's first female prime minister. Takaichi has appointed a cabinet, including the country's first female finance minister. She's now preparing for diplomatic events, including a visit to Japan by US President Donald Trump next week. And Amazon Web Services says that operations are back to normal after a widespread outage that hit a broad spectrum of customers for around 15 hours. The episode disrupted hundreds of websites and apps, including the likes of Venmo, Robinhood and Apple TV. The outage was caused by a database network issue and highlights just how much of the internet is dependent on the operations of the company. And that's your Bloomberg Brief. John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. I'm next on the programme, expecting a fair deal.
I expect we'll probably work out a very fair deal with President Xi of China. I want them to do great. I want them to thrive. But we have to thrive together. It's a two-way street.
In just a moment, we'll catch up with the former White House trade official, Kate Kalukowicz, from New York City this morning. Good morning. Live from New York City this morning. Good morning. Check out this stock in the pre-market. Zion's Bancorp positive by 2.5%. A notable credit loss just last week. Good earnings delivered after the close yesterday. That's been the story more broadly for the sector. These flashy headlines around credit, but ultimately the earnings story's been okay. That stock at 53.31. Thursday's close, following all that mess, 46.93. We've rallied since then. Friday, Monday, and again so far this morning. The broader market this morning looks like this. Equity futures on the S&P 500 pulling back from yesterday's gains. We're down by not even 0.1% after closing very, very close to all-time highs. Under surveillance this morning, expecting a fair deal.
If they don't do business with us, I think China's in big trouble, I'll be honest with you. I don't know that they even make it. I really do. I believe that they're in big trouble, and I don't want them to be in big trouble. I want them to do great. I want them to thrive. But we have to thrive together. It's a two-way street. I expect we'll probably work out a very fair deal with President Xi of China. So most of you will be with us. It's going to be very exciting. And I think we're going to work out something that's good for both countries.
So here's the latest this morning. President Trump optimistic about reaching a trade deal with China, but maintaining he'll hike tariffs if a deal isn't reached by the November deadline. Joining us now is Bloomberg's Tyler Kendall. Tyler, good morning. We heard that word fair. What's a fair deal with China?
Yeah, hey, John, good morning. Well, it could look like a few different things. We know that the U.S. wants to see China in particular drop those export curbs that it unveiled on critical and rare earth minerals, which is why that November 1st date is so interesting when you hear President Trump reiterate his threat that higher levies could go into effect then, because November is also that timeline that Beijing has unveiled for its own enforcement actions when it comes to those export controls. We're going to have to wait and see what's going to ultimately be on the table here. We heard President Trump over the weekend outline those top demands when it comes to fentanyl, soybeans, but also worth mentioning that he did mention yesterday that he also expects Taiwan to now potentially come into these talks, though he did downplay the idea that there could be military conflict in the region and declined to say whether or not he felt that China was going to propose trade concessions in exchange for greater control of the island. We're going to be watching a few different things, but it's clear that this White House ahead of the meeting is bolstering up its position, particularly when it comes to rare earths. We know it was a key focus yesterday at the White House as the U.S. and Australia inked that $8.5 billion cooperation deal, largely seen as a way to bolster against China's grip on the critical mineral market. John, I'll also put on your radar that we got some pretty stark words from the USTR Jamieson Greer yesterday as well, threatening China, saying that it should not retaliate against any foreign companies looking to help the U.S. bolster its position in these critical industries, even beyond rare earths. The USTR threatening action after Beijing moved last week to sanction 5 U.S. units of a South Korean shipping giant amid this ongoing dispute when it comes to the maritime sector between the U.S. and Beijing. John, it's just another thread to pull on as we head into this critical meeting.
Some good cop, bad cop going into negotiations. Tyler, thank you. Building on this conversation, the former White House trade official, Kate Kalukowicz. Kate, welcome back to the programme. We've talked lots about the president's asks going into these conversations, these negotiations. What do we know about what China wants in return?
Well, I think China wants lower tariffs. You know, it seems that they have been dealing with the pressure of tariffs, but that pressure is increasing from other trading partners as well. China's economy is slowing. They're dependent on trade, and I think they are struggling a bit to find some leverage in these discussions, which is why they keep going to this familiar threat to restrict rare earths.
Besides tariff levels, what is the equivalent the U.S. can use that matches China's use of rare earths in the negotiation?
It's a really great question, and I think it's why we keep finding ourselves back in this position where the U.S. threatens tariffs, China threatens rare earth controls, and we end up with a deal that resets us back at the status quo. Both sides are struggling to find leverage outside of these two areas, and I think it's why we now see both of them, particularly the United States, moving to encourage our trading partners to join the fray. We need to bring a bit more pressure from outside because we're struggling to do it ourselves.
Kate, what about barring Chinese companies that are listed on U.S. stock exchanges? Is that a third rail that the U.S. could float out there in these negotiations?
You know, it could be. The United States is increasingly looking at these so-called entity lists, these ways in which they target U.S. companies and their affiliates. So certainly that would be one possible option for them to consider. What's happened, however, is that these actions are really bringing other companies from other countries into the fray. You heard the issue related to the South Korean shipping company. We have a Dutch semiconductor caught in the middle of this. This is creating a very uncomfortable position for companies around the world, but also their sovereign nations.
Meanwhile, there was this deal overnight between the United States and Australia to secure some rare earth minerals, and this idea that maybe the U.S. can source it from elsewhere. How does that fit in some of the discussions that are ongoing with China and the U.S.?
I think it's critically important. The United States, as I mentioned, is struggling a bit in these talks because the reality is we are heavily dependent on rare earths. So you all know how our car and defense and aerospace sectors cannot operate without the rare earths from China. So in the meantime, while President Trump continues to try to reset this status quo with China, he is also ensuring that this is not something that persists. He needs to find other sources of rare earths. The deal with Australia was a really important step forward in securing rare earths from a source other than China, but of course it will take time.
It feels like the administration and actually both sides are trying to buy time to insulate one another from some of the trade partnerships that they have ongoing. And I wonder how much Taiwan is increasingly going to be used as a chip in buying time. I mean, how much could you actually see the U.S. take a step back from protection of Taiwan or some other type of outreach to China, which is something that they would desire?
Well, I think you're exactly right that both sides are seeking to buy time. I think the United States, President Trump made those comments about Taiwan yesterday. That was the first time we've heard that really publicly entered back into this discussion. He's been quite clear, that he does not support any sort of military intervention into Taiwan, but I think he's going to try to dance around and not anger China. But remember, what else is important in bringing allies to our side is in South Asia Sea and what the president is hoping to achieve with the new Japanese prime minister, I think will be very focused on Japan offering some support in the military arena.
Kate, if you're China, do you just want to wait and keep the status quo until the Supreme Court rules on whether or not IEEPA is legal or not?
Well, perhaps, although I don't think that's the wisest strategy. I mean, even if President Trump loses the Supreme Court decision, and that's not a guarantee, he has many other authorities to bring tariff pain on the Chinese. And not least of that, he has all of these export restrictions that he can continue to place. So IEEPA or not, the president certainly is not going to change his approach toward China. And I don't think the Supreme Court is going to be any sort of victory lap for the Chinese in the near term.
Having worked under Trump 1.0, could you see a scenario where he does show up for oral arguments at the Supreme Court?
Anything's possible. When he says he's going to do something, it means he's really considering doing it. So it certainly would not be a shock to me if he shows up there.
Kate, appreciate your time as always. Kate Kalukowicz there, the former White House trade official, with the latest on these talks. Lots has been talked about what the president would like to see, soybeans, rare earths, all of those things. We all understand why. Ultimately, what do the Chinese want in return? Is it tariff relief? I think that's easy to give, given where tariffs are currently, super high. Or is it something else? Does it include an attitude, a shift towards Taiwan?
Potentially, and the president was clear that that would be part of the discussion, but then he stopped there. He didn't want to continue on actually what the United States would be willing maybe to discuss with China when it comes to Taiwan. When it comes to the tariff levels, though, if that's really what China wants, that's why the president continues that even though he says he thinks it's going to be a good deal, he always says, but we have the threat. We could bring it up north of 100% if we have to.
Can we just get some clarity on deadlines? November, it feels like there's two. November 10th, November 1. Which one's which?
November 10th is when the current truce, that 90-day rolling period we have where tariff levels are pretty much frozen back in Geneva in May that they agreed upon, the U.S. and Beijing. That's November 10th. That's the deadline. But they're going to meet before November 10th. So the market will have a lot to adjust, knowing whether or not an agreement was made or not. November 1st is what the president said he can bring the tariffs north of 100%. So he kind of puts two of the deadlines at loggerheads with each other. It doesn't exactly make sense, but keep both in mind.
Mike Wilson of Morgan Stanley, Lisa, had this to say yesterday. It's important to see clearer trade de-escalation from both sides before declaring the all clear on the risk of a further near-term correction. This spat has once again become the story in this market over the last few weeks.
The story, though, has changed from, oh my gosh, this is going to be a decoupling that's going to lead to some sort of Armageddon in markets, to do we get a dip that we can buy and then profit on the other side? So that really has been the feeling, and that is a market shift from April 2nd.
The dips are small and they don't last long. Here's another one. We're down by not even 1/10% on the S&P 500 after closing very close to record highs in yesterday's session. Up next on the programme, we've got some earnings for you. The numbers from General Motors. This is a tough industry. Breaking down the figures in just a moment. Bloomberg's Craig Trudell. Plus, we'll catch up with Yahara with your morning movers. Sunrun soaring on an upgrade from Citi. That stock is up by more than 7%. From New York City, you're watching Bloomberg TV. Two-day winning streak on the S&P 500, the best two-day rally since June. Equity futures this morning pulling back just a little bit. We're down 1/10% on the S&P, on the Nasdaq down by 0.12. For the regional banks, up 4% in just two sessions. The bounce continued through yesterday and continues through this morning. More on that in just a moment. On the Russell 2000, equity futures there negative by 0.24%. Let's get you some morning movers 3 hours away from the cash open. Here's Yahira. Hey, Yahira.
Hi, John. We start with Core Scientific. Those shares are rising nearly 3% in the pre-market after proxy advisor ISS said CoreWeave's $9 billion takeover offer undervalues the company. Now, the deal would help CoreWeave expand its AI computing capacity, but this new recommendation adds to a chorus of worries around the deal and injects fresh uncertainty since institutional investors typically follow the advice of ISS. Moving on to Zions. This, of course, was the bank at the center of last week's credit jitters. Shares are now up 2.5%. I know you all will discuss it. So just to check on shares, up again 2.5% after the lender topped profit and margin estimates, even after swallowing that $50 million hit from alleged loan loss. And we end on the residential solar company Sunrun. Shares are up 6.5% after Citi upgraded the stock to a buy and upped its price target to $26. The call comes as the solar sector tries to regain its footing under a Trump administration that has rolled back green incentives and made a renewed push for fossil fuels. John?
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. On our radar this morning, credit fears easing on Wall Street following positive results from Zions. The company reporting third quarter results that topped estimates despite a $50 million loss from an alleged fraud. Elsewhere, President Donald Trump expecting to make a fair and great trade deal with China's Xi Jinping when the two meet in South Korea just next week. Trump warning new tariffs will go into effect. No agreement is reached by his November 1st deadline. Elsewhere, General Motors shares higher. Those numbers just dropped in moments ago. GM with a beat and a raise.
Pretty much across the board coming out with expectations for the full year adjusted earnings per share at the upper range from $9.75 to $10.50 from the high range of $10. Full year auto free cash flow above expectations. You can go through. It was a really clean read across the board. What's interesting is the tenor of this letter to shareholders. I also want to thank the president and his team for the important tariff updates they made on Friday, talking about making more than 2 million vehicles per year in the United States. A big discussion here, clearly in here, focused on the political backdrop and talking about how tariffs came in lower than expected and allowed them to more effectively mitigate any of the potential ramifications.
The automakers, or rather the lobbyists for the automakers, did their job and got a reprieve. Longer lag time, longer lead time in terms of how low the tariff could be for these imported parts. And you're seeing it right here. They're talking about full year gross tariff impact improved to $3.5 to $4.5 billion from $4 to $5 billion. Not a ton, but they are working on these mitigation efforts. On top of that, the CEO also talking about the evolving regulatory framework and the end of federal consumer incentives. Now clear that near-term EV adoption will be lower than planned. So they are dealing with a number of policy issues in Washington that are impacting their everyday decisions, whether it's EVs, tariffs, or fuel emissions.
Getting a bounce this morning in the pre-market, a stock is higher by 6%. Joining us now from London with more is Bloomberg's Craig Trudell. Craig, welcome to the program. How agile do these automakers need to be when they're getting whipsawed by political cycle after political cycle?
I mean, it's hard to sort of overstate, just how significant that whipsawing has been when you go from, from the Obama administration to Trump to Biden to Trump again. We've seen fuel economy regulations and emissions rules really sort of wax and wane to this really significant degree. And you saw, Mary Barr really sort of answer the call under the Biden administration, building an awful lot of battery supply in the U.S., building also, setting reworking assembly lines to make electric vehicles. A lot of that is now being undone, to the tune of, this quarter they're taking a $1.6 billion charge related to undoing some of that investment. And they've warned that there may be more to come there. On the other hand, all of that investment in electric vehicles and in batteries has been costing this company money, and they've gone from prior sort of forecasting that they would lose less, but that's, that was still going to be a drag, to now they can do away with that. They can make more full-size SUVs and pickups that all along have been what really sort of is their money-making product. And oh, by the way, they don't have to pay for compliance costs to regulatory credit revenue that flows right to Tesla's bottom line. So this is a significant amount of relief for them, even as they have real sort of headwinds from the tariff perspective.
Craig, it's worth pointing out Annmarie's done the same thing. There are positives and negatives for the auto industry. Just on the negatives, Craig, what's been the bigger challenge for this company? Has it been the tariffs or the issues and regulations around EVs?
I think, it's going to be, difficult for them to sell as many EVs as they expected. And yet, again, that may not be as big of a problem for them, at least in the near term. Longer term, that's a big question if this industry really goes electric outside of the U.S. and the U.S. becomes this sort of laggard market. I think in terms of the near term, far and away, the bigger issue is tariffs, and you're seeing Mary Barra sort of trying to mitigate that quickly by investing a heck of a lot in U.S. factories and trying to, sort of rework some of that capacity that had been dedicated to EVs to products like SUVs and pickups, and really banking on the ability that demand is going to be there, where the EV demand that everybody was hoping for didn't necessarily materialize.
Craig, on that tariff point, Annmarie was talking about this, that the company said that tariff mitigation actions are expected to offset about 35% of the costs due to a lower tariff base. Do we have a sense of what type of tariff mitigation actions they're taking? Is this a code for increasing prices? Is it code for laying people off?
I think, some of it is investment. I mean, just in the last few months, this company has announced $4 billion of investment in U.S. factories. And some of this is going to be incremental shifting of production from Mexico to the U.S. I think, that will cost the company some real, capex. And also, I think there's probably a fairly good likelihood of, the need to perhaps consider raising prices to take into account for the fact that production in the U.S. is going to be costlier for GM than making in Mexico. And yet there's also, I think, sort of an argument to be made that, maybe this is for the best for the company going forward, and that, even in an age after Trump, when you're thinking about, sort of the political risk of just how much, manufacturing has been hollowed out in the U.S. and the fact that Trump has proved this is good politics to sort of saber rattle over how much companies are making in America. Maybe it's for the best that GM sort of takes heed here and sort of undoes some of this offshoring that has been taking place over decades.
And we certainly saw that in Mary Barra's letter, where she's talking about $4 billion of investments and onshoring production plants in Tennessee, Kansas, and Michigan, talking about jobs created in New York. I'm just wondering, on the other side of the GM equation, the idea that this is an incredible company to look at because it both is at the crosshairs of a lot of domestic policy, but also can get a read on consumer demand. Do we have a sense of how much consumers are absorbing higher prices, are continuing to buy cars? Do we have a sense of how much that beat as well?
It's a great question because, on one hand, you do see really strong sales of high-end vehicles, particularly, I would say, the big SUVs that GM and Ford make. We're seeing, some of the strongest sales of bigger vehicles, like, say, the Chevy Tahoe, the Ford Expedition, than we've seen, in 20 years. And yet we're also, on the other hand, seeing, higher rates of delinquencies, signs of strain from a credit perspective. And so you do have to kind of wonder to what degree, we're seeing a bifurcation of sort of the best off consumers being able to afford going out and buying a new vehicle. And yet, under the surface is that incremental new car buyer now coming under greater strain than ever, now that we're coming off a month, by the way, which, the average price of a new vehicle sold in the U.S. just hit a record of more than $50,000 for the first time. That's a lot of money for a lot of consumers, and that's likely going to cost us, some incremental new vehicle sales where the consumer says, you know what, I'm just going to buy a lightly used vehicle instead.
Greg, when it comes to their policy out of Washington, what you hear from a lot of auto lobbyists were that at one point, given the president was striking all these deals with Asian companies, you can get a Japanese-made car at a lower tariff level than an American-made car. Given the latest reprieve some of the auto sector industry companies have gotten, are they now on par to compete globally?
It's really hard to answer that question. I think, to what degree, this is a bit of gamesmanship in Washington. You talked about the lobbyists really doing their job here. I think it is still the case that if you're a Toyota or a Honda, that, even if you've gotten some relief in terms of, the cars that you're continuing to import from Japan, I don't think anyone who's, sort of managing, operations for Toyota, Honda, or Nissan is feeling at all comfortable about any capacity that they're relying on from outside of the U.S. And so we're also seeing a lot of incremental investment on those companies to sort of go from any slack that they have in their U.S. Plants, filling that slack, addressing that with investment, localizing more production. And, to the degree that there's some relief being offered by this administration, it is still costing you more than it did, before Trump was in office to ship cars from Japan into the U.S. It's a question of how much sort of competitive dynamics are, wash out. It's really difficult to get to the bottom of, whether this is, good messaging on the part of GM and Ford in Washington as opposed to legitimately, it's you're better off shipping from Japan into the U.S.
Stock is up this morning in the pre-market by 6.5%. Just a final question, Craig. Slightly provocative one. But on EVs and the strategy on EVs from GM, this predates this presidency. And I think we have to bring that up. It's important to highlight. And here's the provocative question, Craig. Do you think in some ways the administration has done this company a favor to get them to focus on the one thing over the other when investors have been asking that question for a long time?
Yeah, I mean, I think it is a question of long-term versus short-term. I think in the short term, absolutely, this is going to be better off for the company in terms of, investment that they're not going to have to make, spending that they've had to make in the past that they no longer will have to. The question will be, for me, is long-term, if this is still the case that we are going to get to a place where electric vehicles are what dominates the global industry. Have we sort of benefited U.S. manufacturers for now, but sort of lost sight of the fact that for the long term, we've only made them, less competitive 10 years, 15 years from now?
Really important framing. Craig, thank you, sir. Appreciate it. Fantastic work. Craig Trudell there of Bloomberg, out of London. Don't miss our conversation later on this morning. The GM CFO in just under 1 hour's time. We're going to catch up with him at 7:30. Paul Jacobson knows a lot about working in volatile industries in his time in the airline business over at Delta, and now at a big automaker heavyweight, General Motors, and they have got to be super agile because things have been incredibly volatile.
Super agile and super political. I mean, you can see that for the letter to shareholders. It talks a lot about Washington, D.C. and investments in the United States. A key question, especially given the fact that they are in these crosshairs of changing policies, how they also face off with a consumer that seems to be somewhat, shifty or difficult to really pin down. And I'm curious about both of those things, policy and the consumer.
Shifty's like shady, right?
Okay,
I know what you meant.
Yeah, okay, baby, just, I don't know, K-shaped, U-shaped, Y-shaped.
Just throw out a letter.
X.
You know how this works on Wall Street.
That's kind of what we were doing this morning.
Basically. Odd start to the programme today. General Motors up by 6.5% in the pre-market. Decent numbers from that company. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Shares of GE Aerospace higher after the company raised its full-year outlook for the second quarter in a row, thanks to the strong rebound in global air travel. The jet engine manufacturer boosted its forecast for revenue growth, operating profit and free cash flow. GE Aerospace shares have soared more than 80% this year, driven by rising demand for maintenance and new engines. And as you were discussing, shares of GM soaring after the automaker raised its full-year outlook and posted third-quarter results that topped analyst expectations on better-than-expected pickup truck sales and fresh relief from the Trump administration's tariffs on auto parts. GM will also be reducing its EV investment. In a letter to shareholders, the CEO, Mary Barra, says it is now clear that near-term EV adoption will be lower than planned. And Apple shares hit their first record this year after Loop Capital upgraded the stock to buy from hold, citing positive iPhone demand trends. Shares rose about 4%, surpassing an all-time high that had stood since December. Apple now closing in on a $4 trillion market cap. And that should be brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. This from Loop Capital's Ananda Buraha saying we are now at the front end of Apple's long-anticipated adoption cycle. Dan Ives of Wedbush has been waiting for this one for a long time.
iPhone 17, have you gotten it?
Getting closer.
Really? Well,
Getting
this is,
closer.
I mean, listen, this is,
I
this
did.
is,
I
this
checked
is
out
the
something.
indicator.
I checked out something in his phone yesterday, and I was like, it's cooked. You got to get a phone.
Yeah, it wasn't working properly yesterday, was it? I know. All right. Up next on the programme, the Fed's easing regime.
Right now, they're almost getting a little bit of a free pass on this October meeting because both are in good shape, consumer spending and corporate credit. But this will help, I think, lower rates would help prevent maybe that next shoe to drop in terms of weakness.
That conversation up next with Earl Davis of BMO, live from New York City. You're watching Bloomberg TV. GM this morning in the pre-market higher by 8%. Really decent numbers from that company this morning. A beat and a raise, even though they've been whipsawed all year. We've talked about mitigation strategies. Seems like something's working over at General Motors.
Yeah, and you can see that actually rebound into Ford shares also up, not as much, but you can see there's a positive tone that maybe the costs aren't as great, the mitigation tactics are effective, and the consumers are still buying cars. And that actually is the key kind of aspect of all of this.
The CFO, Paul Jacobson, joining the programme a little bit later this morning, 40 minutes from now. For the broader market, welcome to the programme. Pretty snoozy so far. Unchanged on the S&P 500, negative by only 0.1% on the Nasdaq. Under surveillance this morning, the Fed's easing regime.
Ultimately, they are telegraphing that they're expecting to be lower over the next few quarters. Right now, they're almost getting a little bit of a free pass on this October meeting because there's going to be more cockroaches, right? There is going to be more credit stress. Both are in good shape, consumer spending and corporate credit. But this will help, I think, lower rates would help prevent maybe that next shoe to drop in terms of weakness.
So here's the latest this morning. Traders locking in bets. The Fed continues its easing cycle at next week's rate decision. Earl Davis of BMO seeing an increasing chance of a 50 basis point rate cut in December, saying the opaqueness and lack of transparency in private credit could be used to accelerate eases. Earl joins us now for more. Earl, welcome to the programme, buddy. So let's skip October. That's done, dusted. What's on the table for December?
Well, December, our base case is still 25 basis points. We just see the chance of a 50 has increased dramatically. And the reason why it's increased dramatically is because we've moved our possible terminal rate. We saw a terminal around 3%, slightly higher than the market, to 250. And the reason why we've lowered it so dramatically is because of, your Tricolor, your True Rand, basically private credit in general. We believe that the private credit, where the opaqueness comes in from and the ownership of it, it's usually real money, pension plans and like. So it's going to be a slow seeping credit move wider, like things wider. So it's binary whether they go 50, but we see an increasing chance of 50 in December.
Do you believe then, based on the credit risk that you describe, do you think it could lead to a broader tightening of financial conditions?
Temporarily, yes, we do believe it can. We don't believe it's systemic. And the reason why we don't believe it's systemic is, as I said, most of the holders of private credit are real money. So they could take the losses. Liabilities, they still have the liabilities to deal with. So it does have an impact on the economy, but they could take the losses. Having said that, why we see it as a possible increasing chance of 50 is they basically took the safety off the gun of 50 eases. And the thing about 50s is central banks just don't do 150. Otherwise, they wouldn't do it. So that's why we lowered our expectation for terminal to 250 by the end of 2026.
So I hate talking about cockroaches this early in the morning, but there is sort of this irony that the reason why there are these fears of credit problems is because of the prolific Fed policy that has enabled this, and the fact that monetary conditions used to be a lot lower to allow a lot of credit creation that may have overlooked a number of different underwriting standards. I'm just wondering if there's a bit of moral hazard here. The idea that the economy isn't cracking and that the Fed could respond to concerns in credit that were done in pretty easy financing conditions.
Yeah, no, we do believe, I don't know if I'd use the word moral hazard, but there's definitely inflation hazard risk because, it hasn't, our growth, despite what's going on in credit, our growth expectations have not changed for 2026. And it's because, big, beautiful bill, everything people are hearing. We think it's very supportive of growth, and growth will still be good. So then you're going to be in a very easy financial conditions market. And we think there's a big risk for inflation, but the market's not focused on that. We're not focused on that right now. We think that's a late 2026 story. One of the interesting things about inflation, though, we do get a print Friday. And if we do get a higher than expected print, the market, credit will widen, duration will go higher. We think that's temporary. We would use that as an opportunity to go longer duration and to go longer credit because we think the 50 basis point eases are very much on the table.
So if inflation is still a concern, Earl, how do you get conviction to go into long-term rates on Fed cuts that affect the front end of the yield curve?
Yeah, it's very easy. As I said, I've been in this market for 30 years. And one of the things with the market is it only focuses on one thing at a time. And right now, inflation is not the focus. So it's determining what is the catalyst to get inflation back on the radar. And there's basically two catalysts. One is employment. Employment starts improving. We don't expect to see that until 2026. And, there's no data or tier one data coming out on employment. And the second thing is geopolitical. And what I mean geopolitical is an oil price spike. That we'll see coming. And we'll be able to adjust positions accordingly. And the reason why I say we'll be able to adjust positions accordingly, in a higher yield bear market, you don't get, yields higher by 2 or 3 or 4 or 5 basis points a day. You get yields higher by 15 or 20. Once you start getting a sense of that, with the catalyst either being oil or employment, when that starts coming out, that's when you adjust duration to reflect that. Right now, it's an easing environment. There's no catalyst for that to turn. And our terminal, as I said before, has gone lower, which changes our view on duration right now.
Earl, will the government shutdown force the market just to focus on inflation? That's the data we're going to get. And what you hear from Washington is that they're expecting a prolonged shutdown, even potentially having congressmen and women come back to extend the date on the continuing resolution because they're hunkering down for a long shutdown.
Yeah, the market will focus on inflation. I think that's fair, but it won't be persistently focused on that because you'll get central banks speak once they're out of the blackout period or at the FOMC meeting, and you'll get people focusing back on employment. And that's why we see it as a buying opportunity because that focus will be very short-lived, very temporary. So yes, it will focus on inflation, but everyone's made clear that employment is the thing that the central bankers are looking at.
Earl Davis of BMO.
Could I say one more thing?
In about 20 seconds, sir, you can, absolutely.
Yeah. Go Blue Jays, go. Thank you.
Oh, my God.
Nice.
Good luck
well
good luck with Ohtani, Earl. Good luck. It's showtime, baby.
Is he allowed back?
Yeah.
No.
Yeah, absolutely.
I thought I was going to be more piercing insight on markets, but it was just shade for Annmarie.
Evidently, although honestly, you're right. Shohei Ohtani was just absolutely a monster. So good luck with that.
Showtime is going to destroy Toronto.
Wasn't that brutal?
That was Earl. I didn't know he had it in him.
Regular
a dagger
watcher.
like
I
that.
think it's great. You're welcome back.
Killing AMH.
Oh, yeah.
Coming up on the programme, Evan Brown of UBS Asset Management, Monica Guerra of Morgan Stanley, GM CFO, Paul Jacobson, and Michael Reid of RBC.
We still have a very resilient and robust economy.
Profitability is still strong. Financial conditions aren't pulling back.
I think we should be very careful about cutting into higher inflation.
You're going to see the balance of risk shift back a little bit towards the inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 down by not even 0.1% following the biggest two-day rally since June on the S&P 500. In the bond market, twos pretty stable, likewise on tens. Across the curve at the moment, pretty much unchanged. Tens at 398, twos at 346. For the day ahead, lots of earnings. The earnings season starts to build up. We had Zions before the close, or rather before the open, yesterday. after the close. We will get Western Alliance after the close today. We've just had GM, decent numbers from them, and Netflix a little bit later as well.
What's interesting is all of these companies are telling a really positive story. I mean, really, they're all coming at different angles. But whether it's Zion's putting to rest some of the worst credit fears and the idea of some sort of big credit bubble that was busting, to GM putting to side some of the concerns about tariff-related costs really coming to the fore, the consumer is still strong from Coca-Cola. You look at all of these things and you start wondering how many people can still feel bearish on the U.S. economy and feel like it is necessary to cut rates dramatically. And yet people are saying that you can cut rates dramatically because oil prices are low. So you put this together and it feels like that melt up just seems poised to continue.
Bramo questioning the bear thesis is the scariest thing I've heard all morning.
That's the top.
Right?
That's the top.
Well, I mean,
not
honestly,
a Gucci blazer.
All I can say is you have to wonder, where is the hole that's going to get poked in all of this narrative? I mean, really, we were talking about earlier about maybe some trade down. Is that really enough to hang your hat on?
Banks are making money. Saw that across the board in the last week. Saw it from Zion's just yesterday. Will we see it with Western Alliance later on? And GM, to Bramo's point, is selling lots of cars. GM numbers are beating a race.
They're selling lots of cars, and they are doing tariff mitigation efforts. And as you said, the CEO is thanking the president in terms of the reprieve the auto industry recently gotten in terms of the high-level tariffs they were paying on auto parts coming into the United States. But still, 2025 full-year gross tariff impact improved. What is the improvement? $3.5 to $4.5 billion from $4 to $5 billion. They're still paying billions of dollars when it comes to the tariff policy out of the United States.
The stock is up this morning by close to 8% on General Motors. We'll speak to the CFO very shortly. Coming up this hour, Evan Brown of UBS as a big tech rally fizzles out. Monica Guerra of Morgan Stanley as President Trump finds a new ally in the rare earth space. And the CFO of General Motors, Paul Jacobson, with a big earnings beat for the automaker. He joins us in about 27 minutes' time. We begin this out with stocks hovering near record highs ahead of a busy week of earnings and inflation data. Evan Brown of UBS seeing resilience in the market, writing until the private sector meaningfully levers up, severe negative outcomes for the economy and market are a low probability. Evan joins us now for more. Evan, good morning.
Good morning, John.
It's good to see you. I think you've touched on something really important. We haven't had the leverage cycle yet, have we?
That's right. I mean, we came into this cycle with multi-decade lows in consumer leverage and non-financial corporate leverage. And that has kind of been our North Star, keeping us pretty glass half full throughout the cycle. It's difficult to get worried about these, systemic credit risks or the consumer absolutely falling apart when you have not had that leverage build up yet.
Even Bramo questioning the bear thesis now. So
I have one.
I'm sure you do. Do you want to share it now or wait?
We can wait.
Okay. Do you want to share what yours is? What is the most credible case now for this bull market running out of steam?
Yeah, I mean, I think the one thing we're all wondering about is the return on investment in AI capex, right? And it's difficult for any of us to have an edge in this because we've never seen it before. We don't know just how transformational this technology is going to be. It could end up being an absolute game changer for humanity. It could be we're just putting out, funny videos that we've made up and sending around, and that's that. So there's a lot of money that's being spent. And there are questions to be raised about the return on that money in the data centers and on the GPUs. And it's difficult to know right now if that money is going to be worth it. But I think, we're still early enough in that cycle that it's not a major concern just yet.
Yeah, and this goes to the AWS issue yesterday and a question around, is there going to be some sort of fissure or inability to deliver on some of the promises just by some of the technical constraints that could potentially torpedo some of these valuations? How much is that part of your short U.S. dollar call?
Yeah, I mean, the U.S. dollar call is less about U.S. equities being, a major concern or an end of U.S. exceptional. And it's more just that we think U.S. rates are going to continue to catch down to the rest of the world. I think the reality is that we're going to have a new Fed chair coming in next year who is going to be structurally more dovish, right? And so that might mean that as the economy recovers, should it recover as we respect, actually it doesn't need to recover that much because it's hanging in pretty well. But, if the economy is picking up, the labor market's picking up, and you're going to get wages potentially rising because labor constraints are now more in effect due to immigration policy. Is that new Fed chair going to become less dovish, thinking about not cutting rates or maybe even hiking rates next year. We think the bias is that it's going to be kind of a run it hot Fed. And that's an environment where real interest rates remain low and the dollar weakens.
I just wonder how much a loss of Fed independence is sort of embedded in this call. The idea of go long equities around the world, go long EM, go long Japanese equities, go long U.S. equities, short the dollar, and overweight gold. How much is this a bet that the one loser is going to be debasement and you can see everything else do okay?
Yeah, I mean, I don't think it's a binary either or. The Fed is independent. The Fed is not independent. I think, you will have a dovish Fed chair who will keep rates, potentially a bit lower than Powell would have. And so on the margin, that is going to be more supportive of the kind of trades that you're mentioning. But I think if you have a chair that has complete lack of credibility, and I think that's difficult to do given it's still a committee, the decision, then that would be something that actually is more concerning. And I don't know if all of those trades, risk asset wise, would do quite as well.
You asked me about the bear case.
Here we go.
Okay. The bear case to me has probably more to do with AI and a question not necessarily of some AI bubble in some of the hyperscalers, but a question of where else has the money gone and how much do we get some sort of constraint from whether it's energy or whether it's some of these other areas that start to not come through in the way that people previously expected. How close are we to that? Or do we have a lot more to run before we even begin to find out where the pockets of excess really are?
Yeah, I mean, like I said, in the overall economy-wide, the leverage is pretty low. The capex that we've seen, the numbers are huge, but as a share of GDP, they're actually not that big compared to the tech bubble. We're talking about less than 1% of GDP compared to, getting up to 5% of GDP that we saw in the tech bubble. We do clearly have some constraints in terms of the grid and energy and the like, but maybe that's a good thing on some level and constraining some of the overbuilding and the like. So yeah, I mean, I think this kind of AI capex cycle still has room here.
You're optimistic on China tech as a way to play the AI trade. How contingent on that trade is it that these trade talks go well?
I think it matters. We did see as soon as we had Trump's tweets on that Friday and talking about 100% tariffs that China tech, the ETFs were down 7%. So it matters for sentiment and the like over the short term. But what we have seen China do is that the more there are export controls on them, the more they kind of find their own solutions and develop their own hardware and own access to GPUs and the like. And so I think over the medium term, those kind of trade scares are an opportunity to get long China tech.
But long term, isn't the writing on the wall that these two economies, especially the technology sector, is going to be further apart from each other?
There will be a gradual strategic competition and moving away, but there can't be a complete divorce between the U.S. and China's economy. And I think Trump realizes that, and she realizes that there's just too much pain to be had on both sides to completely decouple. So, I think it's likely that China gives something on the rare earths, the U.S. gives something on the export controls and the tariffs, and they all realize that the downside scenario is much more severe than either of them want to agree to.
Evan, there appears to be a difference in approach, though. It's something that's been discussed on this program. In the US, these tech firms are investing as if they're confronting existential risk. Capacity, investing loads of money, NVIDIA's really benefiting. In China, by necessary means, they have to invest as if they're facing existential risk, sure, one. But two, it seems to be about efficiency over everything else. And it's interesting to me that this year, we've moved on from DeepSeek pretty quickly. And DeepSeek was the efficiency shock. And then we moved on, and we've gone back to whatever we're doing in the US. Is there an approach that you favour at the moment, the US versus, say, China?
I think you want to be long both approaches, and I think it's absolutely fascinating that in the U.S. we're like, let's get to AGI and superintelligence as quickly as possible, whereas China, whether because they can't due to the export controls or just don't want to, they're saying, let's be as efficient as possible with what we kind of have, and then let's focus on the applications of it. And so I think, that AGI race and winner takes all race is something that's kind of compelling on the U.S. side, even if it might be carried to an extreme. But I think China's approach makes a lot of sense from a kind of efficiency and monetization side, and so be long both, and that's a good diversified way to be in the AI trade.
Evan, it's good to see you. Evan Brown of UBS, thank you, sir. Breaking things down on the tech side, the US versus China. Things are so frothy out there, even France has hit a record high. CAC 40 index surpassing a May 2024, record all-time high. This is just an English France thing, that's all it is.
It's not actually anymore. Now it's kind of the world France thing, considering the recent reputation.
Yeah, not a great weekend. We were talking about that yesterday.
Terrible weekend.
No.
Yeah, I mean, look, this has been an ongoing difficult spot in the world, and it's sort of the weak child now of Europe in many ways, and for them to reach a record high.
And they lost the crown jewels.
We were talking about the French museums.
Yes, but it actually, yes, the Louvre. Where do people sell jewels that they steal where everybody knows where they're from?
Wall Street Journal has a great story on this.
What did they say?
How difficult it is, but how quickly you have to move if you want to basically isolate, chop up these jewels, and then get them out to the market.
Sometimes it's targeted, like someone's got a list and these are the things they want.
Okay, so maybe that's what it was.
For their own private collection.
Yeah.
All I know is that we'll be watching Ocean's 25 for this.
The Thomas Crown Affair.
Yes, exactly.
Fantastic.
I like that too.
Yeah, love that movie.
Yeah,
the Pierce Brosnan one, though.
Yeah, that was good.
Okay, let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Shares of GM soaring after the automaker raised its full-year outlook and posted third-quarter results that topped analyst expectations on better-than-expected pickup truck sales and fresh relief from the Trump administration's tariffs on auto parts. GM will also be reducing its EV investment. In a letter to shareholders, CEO Mary Barra saying it is now clear that near-term EV adoption will be lower than planned. Elsewhere, shares of Coca-Cola higher after posting third-quarter sales growth that beat Wall Street expectations, a sign that consumers aren't shying away from the company's beverages despite higher prices. Coca-Cola reported organic revenue growth of 6%, topping estimates, while adjusted earnings per share also outpaced expectations. And in sports, the Toronto Blue Jays are headed back to the World Series for the first time since 1993 after a thrilling Game 7 win over the Seattle Mariners. George Springer hit a go-ahead 3-run home run in the 7th inning on the way to the 4-3 victory. They'll be facing Shohei Ohtani and the LA Dodgers, who are looking to become the first repeat champions since the Yankees in 2000. And that's your Bloomberg Brief, John.
Touchy subject over here, Lizzie. Thank you. Thanks for the update. Up next on the programme, mining for new deals.
We are discussing critical minerals and rare earths, and we're going to be signing an agreement that's been negotiated over a period of 4 or 5 months. In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them.
That conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. Stocks just about unchanged, turning positive briefly on the S&P 500, going nowhere on the Nasdaq, on the Russell pulling back by just 0.1%. A better tone to this equity market in the last 24 hours. Last week worried about credit risk, particularly around the regional lenders. That was Thursday into Friday morning. That fear has really subsided, particularly with decent earnings coming from Zion after the close yesterday. So the tone doing a little bit better. The focus now on earnings. GM was okay, likewise on Coca-Cola. So far, so good.
And we get Western Alliance later today also that might give another read on just how much these cockroaches are real or whether they are worries that people have. Look, right now we are seeing an economy that still is strong. And it's going to be bolstered by rate cuts. And we're not necessarily having any other data. So why wouldn't the market continue to melt up on the back of this?
That's the latest on Wall Street. For the latest down in Washington, D.C., under surveillance this morning, mining for new deals.
We're here to talk about trade, submarines, lots of other military equipment. We discussing critical minerals and rare earths, and we're going to be signing an agreement that's been negotiated over a period of 4 or 5 months. In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them. They'll be worth about $2. But in the meantime, we're working with Australia and other countries. They're working with us, too.
So here's the latest this morning. President Donald Trump making a deal with Australia to boost America's access to rare earths. It's an attempt to counter China's dominance over the issue. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, what precisely has been agreed between the two countries?
Yeah, hey, John, good morning. So this is actually considered to be a landmark agreement, appearing to make Australia the U.S.'s partner of choice when it comes to mineral projects. It's an estimated $8.5 billion deal that will see the U.S. and Australia jointly invest in critical and rare earth mineral mining, but also processing projects in Australia. Australia has also pledged to invest in U.S. defense companies. There are still big questions here on how concrete the agreement is and how long it will take to implement, but it is widely seen as a win for Australia, which has been trying to ink such a deal at this point for months, because up to this point, the administration has really been focused on these domestic projects. Think MP Materials or Trilogy Metals, which is why our own analysts at Bloomberg Economics say that this really does mark the first real tangible effort by the Trump administration to partner with a credible ally for help in this sector. And while the agreement itself is between the U.S. and Australia, it also is calling for this broader coalition to come together to agree on fair standards and also pricing mechanisms, all in a bid, of course, to compete with China, because that's what's really hanging over the backdrop here as we head into next week in this critical meeting between President Trump and Chinese President Xi Jinping. John, as you well know and discuss on this program all the time, China has a major grip on the industry. It accounted for more than 70% of rare earth global supply last year alone.
Tyler Kendall with the latest down in Washington. Tyler, thank you. With us around the table, Monica Guerra of Morgan Stanley. Monica, good morning.
Good morning.
China's flexed, and it's flexed, and the whole world has listened, and arguably maybe even brought the likes of Australia and America closer together. Was that a strategic mistake going into negotiations later this month?
I think what's interesting about this deal is that China's response was actually constructive on paper, right? They were actually positive, saying, yeah, join the party on rare earths. That was really surprising to me. That tells me that they're not worried. It's going to take at least 5 to 7 years, maybe longer, to have this whole initiative ramp up. A lot can change in that time. Doesn't mean that this isn't going to be a positive for the U.S. I think more, players at the table is ultimately long-term a benefit, but this isn't a zero, end game here.
So going into this meeting, it sounds like, do you think China has the leverage?
I would say that both parties, right, need each other. When we're thinking about our combined economies, they don't want a 100% tariff on all of their goods. That's an issue for them. But they don't really need to worry about this move on rare earths. I think that they're going to be focusing on the other components. China is still in charge of 90% or more, right, of that market. So this isn't a now issue. It's going to make them have to focus on all these other factors that could impact their import-export relationship.
To Jonathan's point, China, though, flexing its muscles on rare earths, is it giving the Trump administration an excuse to continue making these deals where they take outright equity stakes in mining companies?
I'm not going to speak to that, right, to that piece. I think, we were all surprised by the other outright stakes in U.S. companies. Now, as far as the mining company component, we're going to continue to see foreign direct investment, right, directed out of the U.S. in order to make these deals happen. What's going to be interesting is as we build out our relationship with Australia and China, it's like, where do we land on that final tariff number? And I think that, again, when we go back to actually the beginning of the year, that you could see something that's in that 30 to 40% range if we're going to go back to those campaign promises.
Do you think that's where we end with China, say 2026? We're kind of there now on some products.
On some products. I think, you could see an increase on those Section 301 tariffs. You could see more on, Section 232. The other piece here, right, that we have to really appreciate is the U.S.'s reliance on that tariff revenue from a fiscal policy perspective. And the fact that we're in the middle of trying to just even determine if we can have the IEEPA tariffs in place. And once we get that, it's going to be that patchwork on Section 301, Section 232, and others, right, to try to make us whole from a fiscal policy perspective. So I would say from China's lens, yes, maybe they definitely have the advantage on rare earths. Is there something at stake for them, big time, right, when we're thinking about that relationship. But the U.S. also has to think about their fiscal policy future and trying to find that sweet spot.
So given that concern and that hang-up and that, frankly, support to the debt market, how much of a risk case is it if the Supreme Court overrules the tariffs that have been put on and forces the administration to scramble and cobble together another sort of regime of tariffs to plug that fiscal gap?
Well, they're already working on it. So, for example, Section 232 tariffs, you have to have studies put in place. Those prior to the shutdown were in the works. And so I think we need to get through this shutdown period in order to see some of those puzzle pieces come into play. I think markets are right to assume that there will be some tariff revenue coming in at the end of the day. It's just how much? And that's going to be the big question. If they get a negative ruling, there will likely be a market response, right? That's natural. That's going to be a normal course of action, but soon to be backfilled with all those other tariff pieces that they've been, working on heavily.
We got GM earnings earlier this morning, and it showed that the tariff mitigation plans have been working and have offset a great deal of any extra cost. In general, earnings have been pretty positive across the board. Is the takeaway that the tariffs are manageable and that, frankly, companies are adjusting and adapting, and it wasn't as big of a hit? Even if the tariffs go in and remain as such, it's not as big of a hit for the underlying profitability momentum of the United States as expected earlier this year?
I think that the full pull-through, right, of impact of tariffs hasn't been seen yet. So while I think that the GM reporting is a positive sign, that we're finding a sweet spot here, one of the key things we have to focus on is this patchwork, component of tariffs and what that's going to mean for the consumer in other areas. So while they might have found that sweet spot with GM and the auto industry, can they do it across the board when we're thinking about all goods and services? That's to be seen, and we'll get more information in November.
What channel are you and the team focused on? Prices or through the labor market? Cost cuts?
We're focusing on labor market right now, especially as it relates to the shutdown, because this is a really interesting period. Typically, when you have a shutdown, right, people get laid off and then they get brought back. And so that furlough period, you essentially get made whole. Doesn't have a major impact long term. Now, this is different because we don't know how many employees are actually going to be brought back. And so that could have an additional drag, especially when we're thinking about those inflationary factors.
Monica, good to see you. Thanks for being here. Monica Guerra of Morgan Stanley. It is different this time. We've heard that a few times already.
And also the fact that now you see Washington preparing for maybe being in a shutdown longer than November 21st. Talk about labor market data we're not going to get. Also, the clarity of that data, given the fact that a lot of these workers are not deemed essential, so they're not out there collecting these surveys. But when you have the Senate Majority Leader saying, yeah, maybe Speaker Johnson needs to bring Republicans back, so we need to extend the date on the CR, this looks like an administration and Republicans in Congress preparing for a shutdown that maybe will go past the record we had in 2018, 2019 of 35 days.
Didn't get the jobs data for September. Probably not getting it for October anytime soon. It's going to threaten November too.
Yeah, and now we're going to get a CPI, which is probably going to come in hot. So go square that with the idea of rate cuts.
And a bond market rallying into that too.
I mean, everything about this is
some real tension out there.
I mean, market only can focus on one thing at a time.
It's true. Coming up on the programme, General Motors CFO Paul Jacobson with a big earnings beat. Plus, Yahara's got your morning movers. Coca-Cola shares rising on earnings and a resilient consumer. Earnings pretty decent so far this morning. More on that in just a moment. Equity futures, your scores just about unchanged on the S&P 500. Big two-day gain on the S&P, the biggest we've seen since June. On the Nasdaq 100, just about unchanged so far this Tuesday morning. With your morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We have a slew of earnings to get through. We start with GM. Shares are rising 9% in the pre-market. It was a beat and a raise for the automaker after red-hot demand for its trucks and SUVs helped offset tariff pressure. And CEO Mary Barra is giving credit to President Donald Trump because those tariffs were not as bad as expected due to some discounts. And moving on to GE Aerospace, those shares are up 1.25%. The jet engine maker just raised its outlook for a second straight quarter, and that's thanks to booming demand for air travel, which fueled demand for new engines and maintenance work. Remember, CEO Larry Culp broke up the company, and the changes are gaining traction with those shares up 80% this year. And we end on Coca-Cola, another positive earnings story. Shares are up 2.8% after it topped third quarter sales expectations as shoppers continued buying across its beverage lineup. And it was its smaller sized bottles and cans that helped lift sales, showing that consumers are still buying but choosing slightly cheaper options as the cost of living remains an issue. John?
Yeah, Harry, thank you. The stock is higher by close to 4% so far this morning. On our radar this morning, the Vice President J.D. Vance arriving in Israel today. He's set to meet with the Prime Minister Netanyahu in an effort to shore up the fragile Gaza ceasefire deal between Israel and Hamas. The Vice President will hold a news conference at 11 a.m. Eastern Time this morning. Elsewhere, a group of U.S. banks behind the $20 billion Argentina bailout is looking for collateral. The Wall Street Journal reporting the group, which includes J.P. Morgan and Bank of America, is struggling to finalize the loan without leaving themselves on the hook. And finally, Amazon Web Services resolving all issues related to Monday's 15-hour outage, the company blaming a malfunctioning digital directory for the disruption. The outage affecting hundreds of sites, including financial services and gaming companies.
This is about a third of web services around the world, and it raises this question of how fragile some of these companies could be if they rely all on one cloud computing service. It raises a question about the systemic import of some of these companies and how much companies are willing to pay extra in order to duplicate some of those efforts and maybe diversify. A real question here about how much we're hinging ourselves on something that really hasn't been fully secured.
And right on target, you have individuals in Washington like the Senator of Massachusetts, Elizabeth Warren, saying this just proves a point that big tech is monopoly and need to be broken up.
Sometimes it's very predictable in Washington, isn't it? Like we could write the letters for them sometimes based on who they are.
Yeah, but at a certain point, they have to have enough size and scope in order to be able to provide these services. We've been talking about the inability to fuel it through some of the energy sources, and then you're going to say they're too big. I mean, pick one. I mean, okay.
They've got the drafts ready to go.
Yeah. I mean, we just need to go back to
the
pad
senator
of paper.
from Massachusetts just has the draft ready to go. Something malfunctions in big tech. It's like send.
Monopoly one.
Yeah, every single time. All right, Amazon up by 0.2%. Let's turn back to earnings. Shares of General Motors jumping after the company beat earnings and raised guidance. The GM CFO, Paul Jacobson, joins us now for more. Paul, the stock is up by more than 9%. We'll spend some time talking about the numbers, but I just wanted to take a step back with you just for a brief moment. You've got real experience navigating volatile industries, experience in the airline business and experience in the automaker business too. You took over as CFO in the pandemic. Can you talk to us about this year, Paul? Just how agile have you and the team needed to be and how volatile have things been too?
Well, Jonathan, first of all, thank you very much for having us. It's a great day to be at GM and celebrate the success of all of our employees and partners worldwide. So really appreciate you being here today, having me today. So, you know, at the end of the day, it's just another change. I mean, since coming to GM in 2020, we've gone through COVID, we've gone through chip shortage, we've gone through tariffs, we've gone through EV pivots and so on. But what we've really tried to do is create a model that is resilient. And when you look at our balance sheet, you look at our inventory discipline and the way we've gone to market, there's a lot of things that have changed that allow us to be able to react to the world around us faster. And I think that's paved the way for us to have another really strong year in the face of a lot of macro changes.
Paul, in order to increase resilience and maybe agility, do you have to sacrifice long-term planning? Is that something that becomes harder?
Well, you know, I think what we've really done well as a team, I think, is we've kept focus on that long-term vision. So, you know, for example, while we've taken a charge on reducing some of our EV capacity, reflecting the demand that's out there, we still believe that EVs are the future. And we think that there's an opportunity for us to take a little bit of a pause in demand growth that we've seen over the last few years, structurally improve it, right-size our capacity, and make sure that we can be successful as more and more customers adopt it. So it's just an example of how we make sure that we're managing the short term within the face of that longer term vision.
So what are the big steps, Paul, that you've taken in order to remain agile, particularly with supply chains and removing any kind of direct input from China in particular? How much have you rejiggered where you get your goods?
Well, I think we learned a lot in industry from COVID and a focused supply chain that was really susceptible to individualized shocks. And I think we've taken the effort to try to make sure that we diversify our supply chain base. We've made a number of investments, for example, in battery raw materials and other materials in the U.S., in addition to the $4 billion that we've announced this year to increase our U.S. manufacturing capacity. So I think it's been a case of making sure that that's balanced. And then when we went through the chip crisis of 2021, there were some more challenges about making sure that we expand the places where some of our chips are fabricated and our supply base that we use. So this has just been part of it. I think we've learned a lot of lessons over the last 5 years that have helped us and positioned us well to be able to thrive in ever-changing circumstances like we see right now.
All of this costs a lot of money. And I'm just trying to get my head around, we've all been trying to get our head around where it comes from, these extra costs in order to rejigger supply chains, to offset any kind of increased costs that might come along the way. How much is coming from, whether it's freezing labor forces or trimming around the edges? How much is coming from higher prices on consumer vehicles?
Well, I think if you look at what GM has done, we've saved a lot of money by rationalizing our inventory balances. So we used to keep probably about 40% more inventory on the ground at our dealerships around the country. And we've cut that down. That frees up a lot of working capital to be able to invest and redeploy back into the business. But it also makes sure that we can change much more quickly to changing demand around us. So our pricing has been stabilized, and I think that's given us a little bit more comfort to invest a little bit more than what we have historically, but still making sure that we're very disciplined with our capital allocation, because we still have opportunities to pay down debt and also return capital to shareholders. So it's that balanced approach that I think has really paved the way for our success.
Paul, you and your colleagues in the industry recently had a big win in Washington, a little bit of a reprieve when it comes to the arrangement on the timeline for the tariff costs for imported auto parts. What else are you asking in terms of tariff relief from Washington?
Well, I think I want to praise the administration for really listening to the concerns of the industry and making sure that they're helping us to be positioned to be really successful as one of the largest U.S. industrial producers that are out there. And the announcements that were made Friday essentially take what had already been done by the administration in the spring and expands it a little bit to be able to use those MSRP offsets on a wider variety of parts that we're bringing into the country. And as a result of that, we were able to lower our total tariff forecast for the year by about $500 million from where we started the year. And I think it's that proactive partnership in terms of really making sure that we can remain competitive and help to drive more investment into the U.S., which we've done.
So do you expect more reprieves, especially as the U.S. goes into negotiations next year with Mexico and Canada?
Well, I think what we're looking for is a little bit of stability. Obviously, this year's been a bit of a transition year. For us, the handshake deal that we have with Korea, we're really eager to get that finalized. We do have some production of some of our lower cost models in Korea that help with some of the affordability concerns of our consumers here in the U.S. But also, obviously, Mexico and Canada are going to be really important to us. But as we look at those deals being finalized and we start to look into 2026, we think that there's actually an opportunity for us to do better in 2026 than we've done in 2025 and start to work our way back up to those 8 to 10% targeted margins that we set for ourselves before the tariffs were put in place.
Paul, just finally, can we stay in Asia and finish on China? Paul, for a long time we've said on this program, this must be the most competitive market on the planet in any industry. How difficult is it to operate in that country right now? And how much harder is it going to get in the future for U.S. automakers like yourself?
About a year ago, Jonathan, we undertook a pretty ambitious restructuring program in China with the realization that, we were probably not going to be as big in China as we have been historically going forward with the amount of just tremendous competition that's in the country going forward. But, together with our partners, we were able to restructure that business, and we've been profitable every quarter this year and look to be able to sustain that. So it's really about making sure that we're right-sized for where we are. We've got great products over there. We've got a long legacy, and we've got a good partnership that I think has really paved the way. And with that work that the team did in China, really proud of what they accomplished and think we can be sustainable there.
Paul, appreciate your insight and your experience as always, sir. Paul Jacobson there, the General Motors CFO. A beat in a raise from that company. Stock is higher in the pre-market by around 9%. $80 million in China in the latest quarter. That's what GM made. That's a turnaround. That's important.
And it was actually better than expected. And they've been trying to right-size that team. It's sort of a difficult dance between both investing in that nation and also navigating this sort of tit-for-tat between the two countries at a time where both countries are really prioritizing their domestic champions.
Three completely different markets.
Completely.
Right now, you've sort of got China going one way, the US going another, Europe stuck in between, and these global players trying to work out what product sells best where.
Yeah, and exactly what the future is going to be, too. It's sort of the Craig Trudell kind of view of the world. Near term, it might make sense in one region to get out of EVs or to go into EVs. Long term, what is the ultimate goal? And that, I think, is less clear right now than it was, at least what the lip service was maybe a year ago.
GM this morning higher by around 9%. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump and Australian Prime Minister Anthony Albanese have signed an agreement to boost production of critical rare earth minerals in Australia. The two governments will invest more than $1 billion over the next 6 months for initial projects, both pledging to protect their domestic markets from unfair trade practices. Elsewhere, the US government shutdown is in its 21st day after the Senate failed for an 11th time to advance a House-passed measure to fund the government. The impact is being felt across the federal workforce. Senate staffers were told they'll no longer be paid for the rest of the shutdown, and the federal agency overseeing the US nuclear stockpile furloughing most of its workforce. And parts of the White House's East Wing have been demolished as construction begins on President Donald Trump's new ballroom. Trump announced the construction in a social media post, saying for more than 150 years, every president has dreamt about having a ballroom at the White House to accommodate people for grand parties and state visits. And that's your Bloomberg Brief, John.
Lizzie, thanks for the update. More from Lizzie in about 30 minutes' time. Up next on the programme, the last clean inflation report.
This coming CPI report, this one on Friday, is likely to be one of the better ones. What's going to be more worrisome is next month or whenever the shutdown ends, as people come back to the BLS.
The data desert. Get a drip of water on Friday. CPI. After that, I don't know what comes next and when it drops. From New York City, you're watching Bloomberg TV. Live from New York City, welcome to the program. Equity futures on the S&P 500 just about unchanged, on the Nasdaq going absolutely nowhere. Snoozy on the Russell too. We finally get some data later this week. CPI coming up on Friday. Under surveillance this morning, the last clean inflation report.
This coming CPI report, this one on Friday, is likely to be one of the better ones. These individuals were not actually on furlough for all that long, so they're not that far behind schedule. What's going to be more worrisome is next month or whenever the shutdown ends, as people come back to the BLS. Even if the shutdown were to end today and people were to come back tomorrow, they're already going to have to ask about stuff that had happened retroactively.
It's the latest this morning. Investors looking ahead to this week's CPI report, an oasis in the data desert. And I tell you, based on this government shutdown chat with Annmarie and everyone down in Washington, D.C., might be a while before we ever see an employment report.
I mean, honestly, at this point, there seems like an incentive once it gets past November just to keep on going. In the meantime, the earnings have been pretty good, and yet people still have confidence that the Fed is going to cut rates. And this coming from Ed Yardeni overnight. And I thought this was interesting. He said that he thinks that 10-year treasuries could hit 3.75%. Why? Because the Fed's cutting and oil prices. And that's the key. Oil prices keep going down, and that will keep a lid on anything potentially.
When it comes to the shutdown, though, what this administration is doing is trying to mitigate all the pressure points. There's an article yesterday in Political. They're trying to find ways to pay air traffic controllers because, remember, 2019, that was the sticking point. That was the day Trump caved because there was a ton of flight delays going into Orlando, New York City, really big airports. And it was starting to, really hurt citizens, getting curmudgeon. They're trying to find ways because they're preparing for a protracted shutdown.
The Federal Reserve They're essential workers, apparently, we're told. We've got that confirmed. They meet this time next week, a 2-day meeting with very little economic data and the prospect of a big change at the top of the Federal Reserve in May of next year. Joining us in the last week, Governor Waller, a candidate to be the next chief of the Fed. We talked to him about leadership and his view on what's happening in the economy right now. Take a listen. How's the process going? Let's start there and then we can get into all the other good stuff. How's the interview process going?
It's going well. As far as I can tell, the secretary has a very systematic way of going down the list and doing the interviews. As I said the other week, I had a great interview with Secretary Bessent. Talked a lot about economics, Fed policy, the Fed, balance sheet, just general stuff in the economy and financial markets. It went very quick. It was about an hour and 45 minutes. The next thing I knew, it was over. So it was a great conversation. Of course, I love those kind of conversations. I can do that all day long.
The Treasury Secretary's spoken about in the past, he wants almost a visionary, someone who looks forward, like an Alan Greenspan type, open-minded. Do you get a sense of what he means by that?
I think it's the idea of if you're looking at the data and it's always looking back at the data, the data is always kind of old and you have to think forward, like where are you going with this stuff? I've managed to do that a couple of times with thinking about this beverage curve argument back in May of 22, that we could have the soft landing earlier this summer with the weakness in the labor market, which turned out to be true. People doubted it at the time I said it, but so I think I don't want to, brag, but it's that kind of being able to look at the data and see forward where things are going, and I think that's a critical thing he's looking for.
You were certainly vindicated. The president was obviously excited about the fact the Fed finally was cutting interest rates. Have you spoken to him at all?
No, I have not.
Is that on the schedule?
I don't know. That's up to Secretary Bessent.
We're going to find out soon, hopefully. We'll talk to the man himself, the Treasury Secretary, hopefully later on in a month. I want to talk about the meeting that takes place at the end of this month as well. You were pretty clear going into the last meeting. You delivered a speech, and I believe the title was "Let's Get On With It." Yep. Are you advocating for the same thing at this meeting?
Yeah, I think it's the right thing to do. Back then, there was an issue of whether you go 50 or 25, and I argued we could do 25 and see how the data comes in. Of course, we're not getting much data. And then we can think about the next 25. So in the last 6 weeks, I don't think a lot has changed. We're not getting the public data, but all the private sector data that we're getting, Beige Book yesterday, everything we're getting is telling roughly the same story. The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now, because you can't have a really strong growing economy and negative job growth or zero job growth. And people talk about productivity, but AI hasn't had that effect yet on the labor market or productivity. It will down the road, I think, but not right away. So I don't think that's the story that's driving it. So in that case, one of these things has to move, right? Either GDP numbers start coming back down or the labor market rebounds. You just can't have growing economy and very weak labor market. They just don't go together.
In the meantime, do you just continue to reduce interest rates meeting by meeting as you wait to see what's going on? What's your overall approach, and what do you think about that?
That's exactly what I've been arguing, is since we don't know which way this is going to break, if the labor market rebounds, there's less of pressure for cutting rates. If the growth comes back down, there's more pressure for cutting rates. You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do. But if you've already started the process, you're providing whatever's initial support for the labor market that you feel is necessary.
So we've had this obvious step down in payrolls growth. It's pretty clear. Yeah. It feels like that alone, though, might be an outlier compared to everything else that's going on in the economy. You yourself just acknowledged that. What do you think is behind that? And can that persist?
That's the thing. When I've talked to private sector CEOs about hiring, we typically get a couple things. Maybe early part of the summer, there was a lot of uncertainty about tariffs. We're just holding off on doing anything. One of the things I heard is firms were going to have to pay the tariffs. One easy way to do that is just not hire. Take all the labor savings to pay off whatever the tariffs were. So that was one thing. Then you have this AI story, which was people like, we don't know if we're going to need to hire, but we're going to wait and find out. We're not going to go out and hire a lot of people right away. So I think the tariff uncertainty, paying for tariffs, trying to sort out what AI really is going to do, kind of put firms on their back foot. Now, that's what I mean. Either they decide the AI is not going to be in the near term the big job replacement that they thought, and they're going to have to start hiring, and it comes back, tariff uncertainty goes down. All of those things could lead to a rebound. On the other hand, if GDP starts softening, it's not as strong as we think, that somehow the data is a kind of a mirage right now. Then the labor market is telling you things are just not as good as you think. Now, the financial markets are the big puzzle. I mean, I'm not the only one. How much of this is just a big boom in AI and everything else is marginal? I've kind of been arguing there's a big difference between the financial conditions for corporate America and financial conditions for Main Street America. If you're Main Street America, you're looking at mortgages over 6%, very expensive housing, car loans over 7%, credit card interest rates in the 20s. These are not loose financial conditions for American households. So when we look at the financial markets, you're seeing a lot of when people talk about credit spreads and all that. I don't think most American households care what the credit spread between corporates and treasuries are. That doesn't really, unless it shows up in mortgages. So I think there's this is one of the things that I find kind of puzzling right now is there's just always these dichotomies between things. If you look at AI, if you take out anything data center AI related, business fixed investment is turning down. It's not widespread. All this investment is not widespread across. There's a real reallocation from kind of everything else into AI. So there's this bifurcation in so many ways that make kind of reading the economy tough right now.
How much influence do you have on one versus the other? Financial conditions on Main Street versus Wall Street. Wall Street's immediate. Wall Street's gone. It's off to the races. Yeah. Can you really influence financial conditions on Main Street?
Well, that's kind of what we hope. If you think about cutting rates, which we're doing and I think we'll continue doing, that does have a pass-through to the 10-year. And the 10-year is often the anchor for pricing mortgages. So the 10-year is down to like 4%. It's come down from 4.5%. That's about 0.5% off. If it were to continue drifting below 4%, you'll start seeing some downward pressure for certainly mortgages. Auto loans are kind of a different thing. They're trying to figure out how to deal with tariffs on the auto industry. One thing I've heard is they got rid of a lot of cheap financing that they used to subsidize for consumers. That's going to raise the cost of financing. All these things are more tightening for Main Street America. So hopefully these things, as we go on through the rest of the year, start loosening up some.
Governor Chris Waller of the Federal Reserve and potential Fed chief May of next year on the economy and what's happening. All these dichotomies, these contradictions that we've been discussing on this program, the fact you can have employment drop off the way it has, but retail sales have remained solid, the fact that people can freak out about what's happening with credit issues, but bank earnings are absolutely fantastic. We're all grappling with the same thing right now.
And it seems like the Fed doesn't have an edge on it and they don't have the data. And yet what they are seeing is a labor market that is deteriorating and the K-shape that some people reject, but other people see as being one that they need to cater to. And they want to ameliorate some of the issues for people on the lower end of the income spectrum.
And even if we get this hot CPI, they're going to look through it. And they're going to continue to look through it, as you've been talking about really for months, Jonathan. 2026 is going to be so challenging for the Fed because you're going to have to potentially deal with hotter inflation and a brand new regime when it comes to the head of the Federal Reserve.
And a bond market's rallying into it. It's a very intriguing moment in fixed income at the moment. Coming up on the programme, we'll catch up with Judy Beale of Kane Anderson Rudnick, Alicia Reese of Wedbush. We'll catch up with Lorena Urici of T. Rowe Price and the CEO of Atlas Merchant Capital, Bob Diamond.
The key point for growth really is how these tech stocks are doing.
The AI momentum in the near term looks pretty solid.
If there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market.
This is a what we're calling a high risk bull market.
I'm very bullish. I think the market goes to new highs before Thanksgiving.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bound 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your scores look like this. Just about positive on the S&P 500 following 2 days of gains on the benchmark. The biggest two-day rally since June on the S&P 500, leaving behind the credit fears for now at least. Solid earnings across the board from Zions overnight. We saw it from Coca-Cola and General Motors already this morning. Later on, we'll be catching up with Netflix, and you'll hear from Western Alliance.
Yeah, do you get the same sort of confirmation that the economy is solid, that the credit problems are less concerning than maybe some people feared, and that everything is a go? People have been looking for things to worry about, and so far the earnings have not given them that node of anxiety that they otherwise would have gotten. And what you're seeing is really resilience, both in corporate earnings, corporate expenditures, as well as in consumer spending, and that continues to be the theme.
It's a breath of fresh air as the world is trying to figure out, and investors trying to figure out what is going on with the tariff policy going into this meeting with China, as we don't have tier one data coming out of Washington except for what's going to be the CPI print. Zions is talking about that this was an incident, isolated incident, not idiosyncratic, isolated, because Jonathan hates that word. And then GM is talking about the fact that they are able to weather the storm of whipsaw changing policy in Washington, whether it's tariffs, whether it's emissions, or whether or not they're going to EV subsidies or not.
Give credit to some of these management teams. Give a ton of credit to them. Savita Subramanian of Bank of America said it a long time ago. Never underestimate corporate America. The agility of these management teams through getting whipsawed after one political cycle to the other, from Biden to Trump, on things like EVs and tariffs, and they're still making money the way they are.
Yeah, and if you think about it, it'd be Paul Jacobson of GM in the last hour talking about how he came in during the pandemic and he had to manage supply chains during that moment, and they learned a lot from that. Look, they were also the ones, corporate America, that termed out their balance sheets in a way that the United States did not. And so they've been more resilient to the Fed rate cycle in addition to everything else. And it's the reason why people are wondering, well, even if they report earnings that are really good, does that really represent the rest of the economy? Because we have seen that split in a growing way.
Increasing agility, adaptability, are you sacrificing long-term planning? Are you at the mercy of the next political cycle? General Motors would obviously push back to some of that, but that's certainly a question we've got to ask.
We're dealing with that right now when it comes to rare earths. China has the entire control of the supply chain. They have the rare earths, they can process them, they refine them, they can ship the magnets. They doubled down the CCP when it came to rare earths decades ago. They're doing the same exact thing when it comes to EVs, which the United States is flip-flopping back and forth every 4 years. China is doubling down. At some point, China is going to say to EV car makers, GM, Tesla, who it may be, you cannot buy our battery, you have to buy our car. And they are going to become the superpower when it comes to EV car making and shipping.
General Motors this morning higher in the pre-market by more than 10%. Coming up this hour, we'll catch up with Julie Beale of Kane Anderson Rudnick with the latest market rally on pause. Alicia Reese of Wedbush ahead of earnings from Netflix later on today. And the former Barclays boss, Bob Diamond, the CEO. He's going to join us as he remains bullish on regional banking. We begin this hour with stocks flat as Wall Street awaits another round of earnings. Julie Beale of Kane Anderson Rudnick writes, investors will continue to overlook government shutdowns and geopolitical tensions as long as corporate profitability is strong. Julie joins us now for more. Julie, welcome back. You've talked about this a million times too. How impressive is the adaptability of management teams across corporate America?
I agree. I think your sentiment is exactly right. If you think of everything that has been thrown at them, it's not just tariffs, right? It's pandemics, it's supply shutdowns, it's huge swings in demand, huge swings in policy. They've really been able to put their ingenuity to good work. Imagine actually how productive they could have been if we didn't have tariffs, right? How they could have really used their ingenuity in good ways. But that's neither here nor there.
Julie, are you seeing this across market caps? Is this something that just management teams in large cap America can handle well and small caps can't? Or are you seeing this across the board?
I think we're starting to see that small caps really struggled with inflation in a way that large caps had more pricing power and they were much better able to maintain their margins. And then the bigger issue for small caps was they were not able to borrow long with, fixed rate interest. For them, they've been on variable rate debt and they've really struggled under that. I think we've reached the peak of their interest rate costs rising, and now we're in a place where they can finally start to have some earnings expansion just based off of that.
Do you think that's been priced in, or do you think that that's an upside in the months to come?
I think what's interesting, right, in this rally in small caps is that it's been very localized in super high beta stocks and stocks that don't have earnings. So that's biotech and quantum. The rest of the kind of higher quality scale really hasn't gotten to participate in this rally in small cap in the same kind of way. And so I actually don't think it's reflected everywhere in the same. But of course, I'm going to say that I'm an active small cap manager, and I'm going to say that you need to be selective.
I'm trying to square this idea that you're seeing profits reaccelerate in some small caps, that you're seeing earnings from the large caps come in better than expected, the increase in full year expectations that we're seeing pretty much across the board. And yet one manager after another is saying you have to be cautious. You have to move up in quality. You've got to be prepared for the next shoe to drop. Why? Can you square those sort of distinctions, the idea that we're seeing real optimism from the C-suite at the same time that fund managers are looking for something to get nervous about?
I think it's connected to the labor market. I think we kind of all recognize that the part of the reason why we have had such a strong economy is that we have a consumer who is so willing to go out there and spend money. And that has really propped up a lot of this economy in a really major way. If we lose that, as we're starting to see some degradation in the consumer strength at the low income, it really does ripple through this economy when so much of it is driven off the health of what the retail consumer is doing. So I think that's where people have a lot of anxiety. And look, how many articles are you going to read about a bubble in AI and not start to be a little bit worried when you have valuations as stretched as they are?
Julie, not just a bubble, you call it the AI pixie dust that is basically floating around when it comes to the stock market. What vulnerabilities are you seeing?
You know, I was at an AI conference just this last week, and what struck me is how many panels people use the word unlimited. And the word unlimited, when you're in finance, it's a non-word, right? It doesn't really exist. Everything is limited. And if you talk to mega cap tech, they're all talking about how capacity constrained they are, how they need more GPUs, how they don't have enough power and they don't have enough data. It was strange to me hearing all of this talk about unlimited. And it reminded me, do you remember when cell phone plans went to unlimited, right? I used to call my girlfriend, put the phone down and just watch TV with pure silence, right? Because we were so excited about unlimited. I'm worried that we're not going to have the most cogent, thoughtful, capacity-constrained minds with AI and capex, because there's this thought that if demand is unlimited, I can do whatever I want.
So, Julie, is there a side of the story you're more comfortable with? Maybe you want to buy into the constraints and maybe fade the moves where everyone's talking about investing like their lives depend on it.
Like, I think the thing is that the place where you really want to be thoughtful of is now that we're at this stage of the capacity investment where we're using debt, I think it's really critical to have a keen eye on valuations. It's exciting to see places where there's growth and expansion and we've moved beyond the mega cap tech. But part of the reason why mega cap tech can rally with such strength is that fundamentally those names are defensive, even if you exclude their AI benefits. That's not the case for a lot of other players that are more fringe and adjacent. So that's the place where I think you see the most vulnerability. And you see that in the pullbacks that we've had recently. People really run away from those names because they know they're not as high quality.
Julie Bill with the latest. Julie, thank you. Julie Bill of Kane Anderson Rudnick, the latest on the equity market, looking ahead to tech earnings. Next week, Microsoft, Meta and Alphabet after the close on October 29th. October 29th, a week tomorrow. Fed decision in the afternoon. After the close, big tech players report.
You know what I think is going to be more important? Big tech, by far. And ultimately, this entire market hinges on growth expectations that are, to use Julie Biel's word, unlimited, given the fact that that is what we've seen, and that's the promise that people are pricing in with the multiples.
The promise without real use case. We don't see it yet. And this is why it's so uncomfortable for everyone. She calls it AI pixie dust instead of a bubble. But isn't that what is really so uncomfortable? They're spending all this money. Where's actually the use case just yet?
We keep going back to the comments of the Alphabet CEO last summer when he said that greater risk was underinvesting and not overinvesting. That really set the tone for their approach to this whole moment. Meta acting like, behaving like, investing like they're confronting existential risk. That's the psychology of the tech firms right now. That's why you're seeing them invest the way they are.
And honestly, I mean, I understand the idea of pixie dust and I understand the idea of not necessarily seeing the profitability, but every CEO you ask, none of them think it's overstated. And they say that it's just the beginning and that they're starting to figure out exactly how they can percolate it through their staff. So it does seem like they also see the promise is unlimited and they also are investing a lot of money. So we have to start asking the question, how long are you going to wait before seeing a use case while continuing to invest this kind of money? Is there sort of a tipping point at which you can't justify it anymore?
Why people are nervous? Their behavior and their communication is a guarantee of a misallocation of resources. When some of the richest companies on the planet tell you that they believe the greater risk here is underinvesting, you should believe them. You should listen to them. And that's why people are nervous.
Well, and it is going to be something where people lose money. I mean, even the OpenAI CEO, Sam Altman, has come out and said, yeah, people are going to lose money big time and people are going to make the wrong bets. But this is what always has to happen during a technological innovation. It's making people nervous because why buy some sort of data center in the middle of a cornfield out somewhere in nowhere close to a big city if it's essentially there's going to be another DeepSeek moment that's going to bring the energy back close to a lot of these cities? Look, there are a lot of questions here. At the same time, people keep investing.
Next Wednesday, they'll mint money.
Exactly.
is what they typically do. Maybe things have changed, but that's ultimately the expectation for Wednesday's earnings reports. Equity futures on the S&P 500 just about unchanged, with an update on stories worldwide with your Bloomberg brief. Let's cross over to Lizzie Burden for more. Hey, Lizzie.
Hey, John. President Donald Trump and Australian Prime Minister Anthony Albanese have signed an agreement to boost production of critical rare earth minerals in Australia. The two governments will invest more than $1 billion over the next 6 months for initial projects, both pledging to protect their domestic markets from unfair trade practices. And a US appeals court is allowing, for now, President Donald Trump's plan to send National Guard troops to Portland to counter protests against his immigration crackdown. A divided court in San Francisco lifted the order blocking deployment of 200 troops. And billionaire John Katzimatidis is urging Republican mayoral nominee Curtis Sliwa to drop out of the race to consolidate support behind Governor Andrew Cuomo. This echoes the calls from billionaire investor Bill Ackman in an effort to challenge the frontrunner Zohran Mamdani. Katzimatidis, a longtime Republican and former mayoral candidate himself, said that the move is essential for avoiding a potentially damaging outcome for the city. And that should be my brief, John.
Sort of mental gymnastics right now that I'm trying to figure out. The politics of New York City. We've got to get the Republican to drop out to help the failed Democrat defeat the Democrat that won the primary.
Yes. That's correct, yes.
Because the existential risk the city faces.
Yes, correct. You put it perfectly.
The Republicans have got to clean this up.
The Republicans...
Can you just help me out with that bit? Because that's the bit of it I'm struggling with.
Because basically they view Sliwa's not going to win, so they're basically saying they think Cuomo
Shouldn't
is
the
better
Democrats
than
address this
Mamdani.
mess?
Okay.
Is it really up to the Republicans?
We're still waiting for Hakeem Jeffries, who
tweaking.
apparently yesterday said he will at some point talk about it and make an endorsement.
My point precisely.
Okay.
You know?
There's a huge split in the party, and this is
Obviously.
highlighting this. And I wonder at a certain point if there starts to be more consolidation around the center.
The Republicans are like, we prefer the Democrat, not the socialist.
Right. Okay. Up next on the programme, the Morning Calls Plus. Alicia Reese of Wedbush ahead of earnings from Netflix later on today. That conversation just around the corner, live from New York City this morning. Good morning.
We were able to lower our total tariff forecast for the year by about $500 million from where we started the year. And I think it's that proactive partnership in terms of really making sure that we can remain competitive and help to drive more investment into the U.S., which we've done. We think that there's actually an opportunity for us to do better in 2026 and start to work our way back up to those 8 to 10% targeted margins that we set for ourselves before the tariffs were put in place.
That was the General Motors CFO, Paul Jacobson, with us in the last hour. This hour, that stock up in the pre-market by 11%. A beat and a raise underlining the adaptability of corporate America. GM knocking it out of the park in many ways this morning.
Yeah, and highlighting how they're able to adapt and adjust to the changing policy landscape while also continuing to sell cars. It raises a question long term, how much companies can use upper income buyers to support their earnings, because it's the trucks and the more expensive cars that have bolstered things and allowed them to keep prices stable more broadly. And that, I think, is a key question. Are they benefiting from the K-shaped economy, and can that actually sustain things in a way for a longer period of time than people previously expected?
The stock is up by 11%. We'll have more on that stock in about 15 minutes' time. The broader market's doing okay, just about positive, following a big two-day run on the S&P 500, bouncing back from the credit scaries on Thursday. Equity futures this morning just about unchanged. That's the price action. Let's get to some morning calls. First up, JP Morgan raising its price target on Zions to 62, noting credit quality trends outside of Tricolor and First Brands are well contained. Your second call from Wells Fargo downgrading Cleveland Cliffs to underway, calling Monday's 22% rally excess exuberance. And finally, TD Cowen reiterating General Motors as a top pick after earnings, citing positive 2026 commentary. There's that name again. The stock is higher by more than 11%. Let's stick with earnings. Netflix reporting after the closing bell later on today. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, welcome to the programme. What are you and the team focused on when they release their earnings later on this afternoon?
Yeah, thank you so much, John. So I think the big number that everybody is looking for, obviously, now that they no longer disclose subscriber metrics, is the revenue growth number. So, they've guided to about 17% revenue growth. Operating margin, of course, also upwards of 30%. They've guided to about 31% or so. The big thing I think that everybody is going to be looking for is, fourth quarter guidance. Again, we expect strong double-digit revenue growth. Consensus is at about 16%. And then whether they're going to raise their operating margin guide for the entire year, I think that's, again, something that we're looking at. Right now, they're at about 30% target for the full year, whether they take that up and then provide any forward guidance for 2026.
Geetha, can we talk about subs? I know they don't emphasize that anymore, but historically, this name would be the source of massive beats and misses. Have we smoothed that out over the last few quarters, Geetha? Is this easier now to forecast?
I'm not sure whether it's easier, John, but I think definitely we've seen definitely a pattern of somewhat of smoothing. I wouldn't say it's a very smooth story, but I think what Netflix is really trying to get investors to focus on right now, instead of subscribers, is really engagement. And we saw a huge bump in engagement in the third quarter. Think of K-pop Demon Hunters. That was a monster hit for Netflix in the third quarter. By the metrics that we're tracking, it led to about, maybe about a 20% increase in engagement through the third quarter. And we expect that to be extremely strong through the fourth quarter as well. So that is really the new metric that they're trying to get everybody to focus on.
Geetha, thank you. Thanks for jumping on. Geetha Raghunathan there of Bloomberg Intelligence. Alicia Reese of Wedbush Securities has an outperform rating on Netflix and a target of 1,500, writing the following: as Netflix continues to enhance its ads business, its aim of doubling ads revenue this year is entirely achievable. Alicia joins us now for more. Alicia, welcome to the show. We talked to Geetha about it briefly. Can you just offer us your thoughts? What are you laser focused on later on this afternoon?
Yeah, I think Netflix is poised for to hit their guidance this quarter, but I do think the focus is primarily on the fourth quarter guidance and whether or not they give 2026 guidance. I think there's a lot of high expectations that they'll give 26 guidance, and I think they might give a couple metrics, but not overall guidance. The fourth quarter, though, is shaping up to be extremely strong from all the metrics that we have seen. The upfront season was really healthy for Netflix, and they have a lot working for them in terms of their partnerships, live events, and like Geetha said, that there's incredible engagement. And I think that crosses the ad tier as well as the premium tiers. And so they're positioned very well going into the fourth quarter and certainly throughout 2026 here.
We've been talking a lot about how frustrating it is for people, Alicia, to not know where their favorite programs are playing, whether it comes to sporting events or whether it comes to their favorite shows. And that's the reason why M&A has always been percolating in the distance. How much do you expect them to address M&A in 2026? We know that they kind of shunned it this year.
Yeah, I don't think Netflix is as keen on M&A generally as many others. I think Roku and Amazon, the other platforms, are doing a good job of, curating the content and working with the likes of, Roku and Amazon as a platform on just M&E spending, doing some good marketing, having the sports landing page on the Roku. I think it's really helpful. So those are good partners, and I think as Netflix continues to partner with Amazon ads, the Roku platform, and in the future, performance marketers, I think there's a lot more potential with that than pure M&A.
Are we reaching a breaking point when it comes to how much, Alicia, consumers are willing to pay right now, given the fact that prices have been going up significantly and there are so many different outlets?
I think, all the data that we have seen shows incredible resilience on this latest round of price increases, which says to us that, there's still a room. You have something for everyone on the Netflix tiers. You have premium tiers that's incredibly elastic. And then you have the ad tier, which is less so. But, it's reasonably priced. It's, $7. They increased it $1 and, there was no pushback from what we could see.
Alicia, do you think there's going to be any impact from Elon Musk earlier this month in October calling for his supporters on X to cancel their Netflix subscriptions?
There was probably some brief pushback, but our survey work that we did, which kind of coincided with that happening, indicated very little pushback. There's some churn, but interestingly, the amount of people who are planning to subscribe in the fourth quarter who had never been on the service before was higher than we've ever seen it. So I think people are planning to come on for the Christmas NFL games and for some other live content, some specialty content, and all the content that Netflix is bringing to the service to increase that engagement. And they're spending quite a bit on content. That should keep that engagement high and keep those people on the service.
Is basically all press good press? Individuals want to know what Elon Musk is talking about, why he's saying they should cancel their subscriptions?
That's a tough one. I think to some extent, yes. But the boycotts, look at Disney. That boycott, was really impactful, and that was quite damaging, I think. I don't know how long that will last for them, but it certainly did impact them. I think this is less important.
Alicia, are content decisions getting harder? Is that ultimately what we're witnessing here? The kind of content that you produce, you have to be a little bit more careful about the decisions you make and maybe not follow and chase the political winds of the moment.
Sure, to some extent, yes, but you also want something for everyone. And that's what Netflix's strategy is. They have content for everyone, and they have such a huge user base across the world that they have to have something for, people of all political persuasions, geographic locations, so they're trying to get content on there for everyone. That's, to the point that they're, adding podcast content, video games. They have something for everyone. Sports, it doesn't matter. So I think, if people don't like some content, they can avoid it.
Alicia Reese of Wedbush. Alicia, thank you. Appreciate it. Just need Landman. More Landman. That's paramount, right? We get another season.
Yeah, we get another season of Landman.
Very cool.
And Sheridan is, I'm sure, working on his next hit to really placate.
I saw the commercials at the F1 race over the weekend.
I gotta say, I love that show. It was actually amazing.
Fantastic,
it was an amazing first season. So I'm looking forward to it.
You want some more good news?
Yes.
Cane sugar Coke will be sold in glass bottles, according to the Coca-Cola CFO.
How long have we been waiting
We
for
don't
this?
need microplastics.
There we go.
Oh, they're actually
another
more
win for RFK, right?
Yeah. I mean, it actually is.
There are more microplastics in recycled glass than there is in plastic bottles. They've actually found that.
You're just trying to ruin this for us.
Yeah, I don't think that's true.
A glass bottle of chilled Coca-Cola with cane sugar.
I think it's great. I'm just
fantastic thing, Bramo. Why are you a downer about everything?
I'm not a downer at all.
The opening bell 60 minutes away after closing yesterday. That close to all-time highs. Equity futures on the S&P 500 up by not even 0.1%. On the Nasdaq, just about unchanged. Earnings so far this morning, pretty good. Coca-Cola, General Motors, Zion's overnight. More still to come. With your morning movers, let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Exactly. A strong showing in earnings. And among the winners is Halliburton. Shares are up nearly 5% in the pre-market after the oilfield services giant beat on revenue and blew past suggested earnings estimates, even as oil prices remain under pressure amid global oversupply. So investors are rewarding the company's ability to hold up in this tough market. And we move on to Coca-Cola. Those shares are also rising 2.7% after it topped third quarter expectations, thanks in large part to higher prices amid steady demand. The company raised prices 6% in the last quarter, and yet shoppers continue to snap up its beverages. Coca-Cola Zero Sugar was a standout in the quarter, topping sales of Diet Coke. And yes, they are two different products, but I'm just waiting for that cane sugar Coke that's, as you said, is coming in glass bottles. And we end on GM shares. Those are stealing the spotlight this morning, up 11% now. It was a beat and a raise for the car maker after red hot demand for its trucks and SUVs helped offset tariff pressures. And CEO Mary Barra giving credit to President Trump because those tariffs were not as bad as expected due to some discounts. CFO Paul Jacobson saying the same to you guys earlier. John?
Thank you very much, Yahira. Diet Coke's got a different flavour profile. You know?
Have you ever tasted Diet Coke?
Sure, of course, yeah.
Okay.
Once upon a time.
Okay.
I'm a Diet Coke
I'm not a regular
fan
drinker.
Over a regular
I've never
Coke
met
fan.
a healthy person that is a regular drinker of Diet Coke. Have you?
How do you define healthy? I mean, honestly, yes, okay, sure. It's not a healthy thing to do, but everyone can have a treat.
Two biggest Coke drinkers I know, President of the United States and the former Treasury Secretary Janet Yellen.
How healthy are they? Don't
No
go
comment.
there. Don't go there. Let's stick with General Motors. The stock's surging after delivering a beat and a raise. Does she still smoke? I think she still smokes, right? Or she quit?
Definitely likes Diet
Okay,
Coke.
back to GM. Bloomberg's Craig Trudell joined us now for more. The stock is higher by close to 11%. Craig, don't worry. We're avoiding all of that. This is a safe place for you. Let's talk about General Motors. Craig, just frame for us how impressive this beat and raise is, given what this company has faced down so far this year.
Yeah, I can vouch for GM being healthy. I think the trifecta here, as Evercore put it, was a beat, a raise, and also maybe some upside for the fourth quarter, and even sort of an early taste of where GM's head is at for the outlook for 2026. I think there was a lot to like in these results, and coming into these numbers, reasons for pause. Right, we've been very concerned about the degree of tariff disruption to car makers, and even the likes of GM, where as big as they are in the U.S., as much of a presence as they have, they also do a heck of a lot of importing from Mexico and Canada and even South Korea. And so, for them to be able to execute through all of this tumult is pretty impressive for the company, and the reason why we're seeing the shares move the way they are.
Craig, in a few days we get Ford. Did the bar just creep higher for Jim Farley and the team in a few days' time?
I think absolutely, and we've seen this, sort of long-standing, pattern of Mary Barra and GM sort of outperforming Ford from an execution standpoint, where Jim Farley will be the first to sort of cop to this idea of, particularly on warranty expense and quality issues. We've seen that continue into this year, where Ford has had to, delay, new product introductions and really take it on the chin in terms of, just how much it's spending on a regular basis with recalls and fixing up vehicles that have already been sold. That is something that we've not seen anywhere near to the degree out of GM. So much sort of smoother execution on GM's part through all of these ups and downs that is difficult for any automaker to be navigating at this juncture.
Craig, just before you go, in just a moment we'll be talking about prices, looking ahead to CPI data in America that drops on Friday. Can you briefly describe pricing power and how that's evolved at these automakers and whether that changes going into the new year?
Yeah, we've talked, offline. Annmarie and I were just exchanging messages. It really is eye-popping to see average new vehicle transaction prices with a 5 on it, $50,000. Last month that was a new record for the U.S. We've absolutely seen pricing power, and yet we've seen reasons to be concerned about just how sort of long-standing or sort of sustainable that is when we see 84-month auto loans becoming the new 72-month auto loans. There is a reason to sort of pause and consider just how long we can sort of keep this up, and as we monitor this industry closely, of what some of the dynamics are under the hood that are allowing for sales to continue at a strong level for the likes of GM.
50K. Craig, thank you, sir. Craig Trudell. And when we talk about the banks and some of the credit issues, this is the industry that's been a source of some of those issues more recently.
Yeah, especially when you talk about the idea of a 7-year loan to buy the car. And what you're seeing is the pace of the value of the car is actually coming in lower than the total outstanding loan that people owe. It creates a real issue in terms of just what kinds of losses there could be on the financing of this, and what the willingness really is to continue to extend it.
Let's talk about prices. $50,000 for a car. Unreal. The data desert getting a drip of water this week, with the September CPI report set to be released on Friday. Blurino Urucci of T. Rowe Price writing the following: the availability of data has been curtailed because of the shutdown, but what we have seen so far from the private sector suggests that the economy is still holding up quite well. Blurina joins us now for more. Let's start with that data on Friday. There are several sources for inflation: goods, services, energy and labour. What's the dominant source at the moment?
I think there is an interaction here of various components of core inflation. So we'd seen deflation and disinflation in goods, in the goods sector for quite some time, and that's reversed this year. I think that's a combination of a number of factors, including tariffs. And it's true that the pass-through of tariffs to consumer prices has been slow, but we've seen signs of it already happening this year. But I also think that we are seeing a stickiness in services inflation that hasn't been here before. We're looking at 3% or more services inflation. It has not gone back to pre-pandemic levels yet. And that, I think, is reflecting the fact that you have a labor market that maybe has cooled a bit from the peak of the tightness back in 2022, but it's not really weak. And we're talking about consumer demand being there and sort of consumers finding different ways to fund their spending. Perhaps initially post-pandemic, it was being funded by excess savings and aggregate income being very strong. And now it's shifting a bit more to leverage and financing of that consumption. So there is a resilience here on the part of demand that is allowing companies to continue increasing prices at a pace that so far is not consistent with the Fed's 2% inflation target, I'm afraid.
How much has the inflation story really been muddied by oil prices that have come down as much as they have?
I think that's definitely been very helpful for two reasons. We're seeing headline inflation running a little bit below core inflation every now and then. We also know that consumers, they buy oil, they buy gasoline on a daily basis. They're much more exposed to it, and it can affect inflation expectations. So I think this has been helpful for policymakers. But if you're looking at where inflation is going to settle over the medium to long run, I think core inflation is really what matters. And I think the fact that we've been now for over 4 years above the inflation target, and we've been stuck at 3% for the last 12 months, I think that's problematic, even with the help of energy. One other area that I think we're not paying enough attention to is food inflation, because, again, this is something that consumers buy more frequently, and it can affect inflation expectations, even though it's not part of the core index. If I'm correct in my prediction, I think in 2026, we will see a pickup in food inflation, both food services as well as food at home. And that's going to be a mixture of the fact that we are importing food ingredients and we're going to pay more tariffs on them, but also the tightness in the labor market and the immigration enforcement that seems to be one of the key pillars of this administration's policy. I think that's going to lead to tightness both in farming, in the farming industry, but also in retail and hospitality. And that's going to reflect in higher prices next year.
Gloria, what's the role of the Fed in terms of curtailing inflation right now? And I ask this because a lot of these inflationary forces are exogenous and don't necessarily come from wage increases and the typical wage price spiral. And there's this idea that some of this will just work itself off on one-time effects. And the Fed wants to cater to the fact that there is weakness in certain parts of the labor market. Do you think that if the Fed cuts rates later this month, in December, that actually will cause a reacceleration of inflation higher?
I think the risk is there. The ingredients are there for a reflation or inflation trade in 2026, and I'll tell you why. I think, of course, we've seen that deceleration in employment growth, and that's something that is concerning the Fed. And it has a dual mandate, and it needs to pay attention to the employment side of the mandate. But when you look at the unemployment rate, that's still fairly low. Wage inflation has slowed, but it has not come down all the way to where it needs to be to hit the 2% inflation target over the medium run. Maybe there will be productivity gains next year that will help the Fed on the wage front, but we're still not there at target. And then I honestly think it's problematic that inflation has been stuck at 3% for the last year, for the last 12 months. And we also have seen since spring a real easing in financial conditions. We know that that works through the economy with a bit of a lag. So next year, we're going to have the boost to demand from easing financial conditions and probably some positive fiscal impulse. I know that over the forecast horizon for the government, the deficits will be neutral to growth, but over the next 12 months, I think they will be positive to growth. So you have, in my view, a rebound in activity next year, held by financial conditions easing and some positive fiscal impulse. You have an unemployment rate that is still fairly low. U.S. consumers don't have excess savings anymore, but they're very good at leveraging. And we just spoke about that, and taking auto loans and extending the window of borrowing compared to previous business cycles. So you can do all sorts of things to support demand next year. And you have a Fed that is easing or cutting interest rates when all those factors are pointing to demand picking up in 2026. I think that sets us up for an environment where inflation certainly won't go back to target, but it might even accelerate.
You wonder where that leaves the bond market, which is 90 basis points lower on a 10-year maturity compared to where it was in the middle of January. Blorina, thank you, as always. Blorina Urici there of T. Rowe Price, looking for higher inflation in 2026. The Federal Reserve's cutting interest rates into that.
And at the same time, what we heard from Earl Davis earlier is that even if the Fed cuts aggressively, it's going to cause the long end to rally. And when we asked why, it doesn't make any sense if you expect inflation's going to pick up. And he said, well, the market can only focus on one thing at a time. So that's a 2026 story. And that seems to be what a lot of people are banking on.
Chairman Powell set himself up to ignore it. Is this market going to ignore it too? Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. A US appeals court is allowing, for now, President Donald Trump's plan to send National Guard troops to Portland to counter protests against his immigration crackdown. A divided court in San Francisco lifted the order, blocking deployment of 200 troops. Elsewhere, Unilever has delayed its demerger from Magnum Ice Cream due to the US government shutdown. The company shared the SEC is currently unable to approve its registration to list on the New York Stock Exchange. The spun-off unit was initially scheduled to debut in the Amsterdam trade on November the 10th, with planned secondary listings in New York and London. And police are still looking for those precious jewellery stolen from the Louvre and the thieves behind the heist as well. The robbers got away with a haul on Sunday that included a tiara, an emerald necklace, earrings and a sapphire necklace. They dropped a crown and a yellow vest with DNA traces, which gives authorities hope for recovery. And that's your Bloomberg Brief, John.
As you do, just casually dropping a crown.
Okay, actually, they damaged this crown from the 1800s, and people are saying amateurs. That was their response, amateurs. Come on, get with
Lizzie,
Ocean's 11.
Thank you. Great work, Lizzie, as always. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with the former Barclays CEO, Bob Diamond, as he remains bullish on regional banking. That conversation up next.
We kind of all recognize that the part of the reason why we have had such a strong economy is that we have a consumer who is so willing to go out there and spend money. And that has really propped up a lot of this economy in a really major way. If we lose that, as we're starting to see some degradation in the consumer strength at the low income, it really does ripple through this economy when so much of it is driven off the health of what the retail consumer is doing.
That was Julie Beale of Kane Anderson Rudnick talking about the adaptability of corporate America and a whole lot more. As we count you down to the opening bell, lots of earnings in focus. Later on today, Netflix results after the market close. You'll also hear from Western Alliance 2. As we make our way to Wednesday, Tesla and IBM results. On Thursday, numbers from Intel, Ford and American Airlines. On Friday, CPI data, the main event on the data front, because we don't get much of it these days, and UMich consumer sentiment going into the weekend. Let's stick with earnings. Zion's reporting a beat on earnings with a net income of $222 million, despite a $50 million loss from an alleged fraud. The former Barclays CEO, Bob Diamond, writes the following: the dislocation in regional banks stems from a few single bank-specific issues, but doesn't change our view on the opportunity. We remain very bullish on regional bank consolidation. Bob joins us now for more. Bob, good morning.
Good morning, John.
It's good to see you, sir. Look, a few years ago, we had some problems managing interest rate risk. Can we avoid it with credit risk in this segment now?
I think broadly in regional banks, as you just quoted me, we're very bullish. I think, both the interest rate dislocation that started with SVB or was recognized with SVB, and we're really a function of rates going from 0 to 5.5%, is in the market. I think the regional bank area has some really strong banks and some that are not as well managed. So, of course, some have more exposure, for example, to commercial real estate than others have. And if the commercial real estate is in Iowa, it might be different than if it's in LA. So we look at all of those things. But as a sector, this is a really, really strong sector, the banks. There's 4,500. It has the support of Secretary of the Treasury Bessent, that consolidation is necessary. Makes the banks more competitive. It increases the ROEs. It makes them just better investments. And I think 4,500 banks in the United States of America, it's the wrong number. And so we see this going over the next 2 to 3 years to closer to 1,000 or 1,500. And we think also, John, I think this is really important. The thesis here is one of consolidation and taking costs out. So many of these smaller community banks are just too small to succeed. They're very good banks, but to get a positive ROE with technology costs, with regulatory relation costs, virtually all of these banks have the same technology platform. So you eliminate one technology platform. Many of them, or all of them, have regulatory relations staffs. You can eliminate one of those. You don't really need two. So if you add the cost synergies, which we've proven in back testing really come out and are real, and you add the increase in ROE, because when a bank buys another bank, there's purchasing accounting, and you have to market fully through the P&L, the bank that you're acquiring. You're putting capital in. Automatically, the ROE goes up because the asset prices are different. So when we look at the cost savings, we look at the increase in ROE, we look at 4,500 banks, we look at too many or too small to succeed. This is probably the best investment we've seen where the downside is really, really protected and there's good upside.
It's happening. Your forecast is happening. Yeah. We've seen it with Fifth Third and Comerica. You're suggesting there's more to come. You talked about how region-specific some of these issues can be. Is there a common thread in the consolidation so far?
I think what we have seen is where the synergies are most clear is in-state and close to state. So when you have a really good front office, meaning you have a good business around deposits and loans, and a similarity in terms of region where you're really adding clients and customers and taking out costs, those are the best opportunities. But not in terms of where in the U.S. It's more that in-state and close to state is the preference.
There's been this fear that some of the biggest banks have really taken the wealthiest and the highest credit ratings in terms of customer base, and that mid-tier banks are stuck with everybody else, and that's where the credit problems have really come. Has there been anything that you've seen that proves that to be true?
No. We've seen idiosyncratic issues. We've seen certain banks that, may have a specific name issue. But the truth is that, 40 to 50% of lending to small businesses in the U.S. come from the regional and community banks. They don't come from the big banks. Many of the big four, many of the larger regionals just don't have the cost structure or the attention to service smaller businesses. So we think the credit quality on balance in lending is very, very good across regional and community banks.
If there's no real weakness that they're seeing with respect to consumers or smaller businesses, does it make sense, and does it really help the case to have the Fed cutting rates at the same time that inflation is still a concern?
I think the cutting rates, if you think of the go-forward environment, so let's say a regional bank buys a community bank, you get the synergies, you have an ROE, and now you're focused on additional acquisitions and what's the go forward. The go forward is terrific. The Treasury, the Fed, the SEC are encouraging consolidation. They're talking about simplifying capital rules. They're talking about endorsing these mergers and this consolidation. And then you have rates at 4 to 4.25%, likely coming down this month, potentially again in December. You have 100 basis points between 2s and 10s. You can't make a better environment for banks going forward than this. So if you strengthen through consolidation, and then you look at the go forward, obviously, assuming that the economy stays stable and strong, it's a great environment for banks.
But you're forecasting at least that 4,500 number to be cut in half in the next 3 years. Is that right?
More than that.
More than that.
Yeah.
How is that possible?
I think one of the situations we faced prior to this administration is there wasn't quite the same support for approving mergers. Was it Elizabeth Warren and Bernie Sanders a little bit on the edge? Like, I'm very, very surprised, Annmarie, that Elizabeth Warren would come out and say we shouldn't approve consolidation in banks. And we're talking about putting additional capital in banks, making them stronger, making them better competitors with JP Morgan and Citi, and yet she's against it. And that's the politics of being a liberal and saying no, no, no to anything that looks like it's positive for business and positive for profits. This administration has been very clear. It's going to make the banks stronger. It's going to make them better competitors to the big banks. It's going to provide more lending. In a way, it's getting more, it's kind of monetary easing, right? It's getting more money into the market for businesses that need to raise money, small businesses to expand what they do.
Bob, we've got 30 seconds left with you, which is not enough, I know.
Oh, come on, give me more.
The mayoral race in New York City.
Yes.
The beating heart of capitalism and the socialist is ahead. What's your brief take on what's happening in this city?
You know, I think the city is at the strongest it's been since pre-COVID. You know, I live in Midtown. We have our office in Midtown. I walk to work in the morning for 11 blocks, and I have never seen so many people on the streets every morning as we've seen in the last couple of months. The city was really hit by COVID. It was really, really tough. I think we all kind of, you know, struggled through, not quite able to admit this is really bad. And it's really good. The city's back, new restaurants, new clubs, people excited, down in the village. My son and his family who live in London are moving to Brooklyn. They're really excited. I think the city has a lot of buzz.
You managed to answer that question without
Don't
answering
you love
that
the way I avoided that?
He's running. Diplomat.
Bob Diamond, everyone.